Hello to all of you. Are you ready for day 2? Let me stop sharing so you can see me. Sure. So we got a big day today, and this is an interesting day. I often wonder, it's this challenge is 5 days long, and yet sometimes I feel like I need 5 weeks or 5 months because what I've learned in 28 years, we're trying to synthesize into a few hours. And that's really tricky. Like if you think about it logically, so I want to give you as much information as I possibly can. And yet by the same token, I don't want to overwhelm you. Yeah, it's always a tricky one. Let's rock and roll. So nice to see so many people online, and I want to get straight into day 2 in terms of the process. So let's get going. We've got a busy day today, lots of information to share. So I want to get on to day 2. Types of investments, asset classes, and risk. The different types of investments and balancing risk and return. So what is day 2 all about? Well, we got the different asset classes and risk. We got understanding the relationship between risk and return in investments. We got identifying personal risk tolerance. And we've got identifying how diversification can mitigate risk. So just a couple of tips that I would highly recommend. The first is that, I tend to find I often turn up and I watch webinars and masterminds and whatever else. And, I'm kind of busy. I'm on my laptop. I'm doing other things. I'm reading my emails. I'm doing social media, etc. So my strong recommendation is that for your future self, pay full attention. No emails, WhatsApps, Facebook, Twitter, etc. Take notes. Try and teach to other people. Use the community. Play full on. Do the exercises. Commit to action for 5 days. We're going to be talking a lot about goals. Take action and have some fun. So they're just some, strong recommendations that I would have for you in terms of the overall process and getting the results that you want. Just by the way, who's excited, Jack? Based on what you learned yesterday, are you excited? Do you think this can make a material difference to you? Yeah. Okay, great. Because I am, for me personally, the lessons that I'm sharing with you were some of the biggest game-changing lessons that happened in my life, and that's why I so enjoy kind of sharing it with people. Okay. I remind you of the resources. So again, I'm sure Shane will chuck it in the chat box as well. If you haven't already been there, you've got the resources guide. Shane's made it really easy for you. You can literally go and click on it and, find stuff, etc. So literally, if you go to the resources guide, I think if I go to I should still have it here. You can see all the things that I've opened even since yesterday. Where is it now? Yep, there it is. So you got the resources guide. So, and again, we're on to day 2. So you got day 1 resources. Now we're on to day 2, and you can see all the day 2 resources. So everything is here. I really like the way Shane does this. Makes it hugely easy for people in terms of that process. Okay. Right. I see Shane has put the resources into the chat box for you. Again, I would recommend joining the Facebook group and, chatting and there's nothing better than working with like-minded people in terms of growth and opportunity. The WhatsApp group, if you're not on it, it's where we communicate and let you know what's going on and how stuff is working. And then I want to remind you, and this is something you're going to see a lot of from me, but the overall goal is globally diversified passive income. And we don't need to diversify across countries, currencies, assets, partners, and time. Like that's our objective. Now, any big goal, the way to achieve a big goal is to break it down. So your big goal is globally diversified passive income. You then need to have sub goals or mini goals, and then you have tasks and activities. Now, when we run our mastermind, this is exactly how we do it. I get very clear with you on what your top 3 outcomes are for the year. And then we break it down into mini milestones that we achieve monthly. And then we got tasks and activity that we achieve daily and weekly. Does this make sense? Just tell me quickly in the chat box if this makes sense, because you know, something I'm sure you've heard before, but how do you eat an elephant? You chunk it, you break it into parts. And so something might feel very overwhelming, like, oh, I'm going to become a global citizen. I'm going to have globally diversified passive income. You know, I'm going to have generational wealth. Like, these might be massive mountains that you've been trying to climb all your life. And yet, actually, if you break it down and you get very clear on the goal, you have sub goals, and then you have tasks and activities, it actually makes it possible. You're feeling a bit overwhelmed? And I always find it fascinating watching how many people turn up on day 2 compared to day 1. So the dabblers are gone. Bye-bye. They're on to their next thing. So now it's just the stressors that are left and the people that want to be masters. And, you know, again, I want to remind you with mastery that I very consciously am taking you on this journey. So, and it's going to happen even more so today. You're going to realize a whole bunch of stuff that you don't know. So you're going to move from this where you don't even know what you don't know to over here where you now realize there's a whole bunch of stuff that you don't know. But my strong suggestion is that just have patience, because we're going to take you on this journey. We're not going to drop you, and we're going to give you a very clear path as to how you get to the end. Day 1 was all about diversification. Why is diversification so important? Does diversification equal financial success? That was our hypothesis. I think we can safely say that we proved it. And if there's one stat that for me proves it more than anything else, it's the fact that Ray Dalio runs $160 billion, has done it for 40 years, and has an average return of 21% year on year for 40 years. I mean, I think if we over a long term, 40 years, $160 billion, and then he shared his secret formula where he said you need 15 quality investments that don't move in tandem. Like, that's how he's achieved his 21%. And he says that the single most important component to financial success is diversification. Can we safely say that that hypothesis is proven? Yes or no? I didn't just take Ray Dalio. I took 10 others or 9 others. But for me, he's the best by a long way. So just to remind you of your action stats, you know, identify and list the risks associated with not diversifying. People move 4 times more away from pain than they do towards pleasure. So I'm doing that on purpose. I'm dialing down the pain or dialing up the pain so that you actually take action. Write down what's stopping you. Fill in the global sheets. Fill in your 5 whys. There, one key takeaway with people on social media. So this is your learning. And then your gold is create a list of your assets or investments you currently hold and identify any concentration or risks. Okay, so just reminding you. And then in terms of next steps, you know, this is always there, but it's our navigator. It's what Shane has helped you. He's built it so that it's kind of like a digital, someone holding your hand digitally and helping you with your next steps. So yeah, you should have that link. Thanks, Shane. I see he's put it in the chat box. Just a reminder, I do say this every day. You know, I'm not giving you financial advice. I'm just sharing with you my knowledge, my mistakes, my lessons, so that you can hopefully avoid the potholes. But I feel very strongly. I had someone yesterday that was a financial advisor asking me if I give financial advice, and I said no. I like to empower people. I don't want to take away your power. I want to empower you. I want to give you the knowledge so that you can make the right decisions for you and your family. I feel very strongly that the 21st century is all about partnership and collaboration. However, to do that, each of us need to take individual responsibility for our lives. The homework competition. So again, you know, you need to post your homework every day in the Facebook group, and those that do will get prizes. And so just reminding you that the prizes will be an upgrade to the VIP room in terms of that process. So the winner for the homework is Mandy. And Mandy, I can see you online. So congratulations for not only doing your homework, but sharing it. So big round of applause to you. And you've been upgraded to the VIP room. I can see Fern is here as well. She won yesterday. And yeah, I love the VIP. In fact, I actually prefer it more to doing these live sessions, these main sessions. And the reason being is that for me in the VIP, that's where we truly get to meet each other, get to know each other. You can ask anything you want. And I feel very strongly that anyone, I always say any monkey can do a PowerPoint presentation, but it's in the VIP that you truly get to ask the questions that you really need to know and, get that sort of authenticity that people want. So anyway, well done to Mandy and to the rest of you. We're only on day 2, so there's still plenty of time as long as you do your homework. And then just reminding you that today we will also have another prize at the end for the person that shares the most and engages the most in the chat. And if you don't want to leave it up to random and you want to join the VIP, it's still, just go to that link and you can join the VIP. As I say, we tend to find from our own stats that the people that are part of the VIP are the ones that get the most results, because people who pay attention. Let me say that again. People who pay attention. Okay, I remind you of our 2 sort of avatars, testimonials. You got Jordan, who's 55, worked all his life for his portfolio and wants to preserve his wealth. He wanted to build a globally diversified passive income of originally 5,000, then 10,000, and then 25,000 simply and safely. He wanted to diversify his investments across countries, currencies, and assets. He wanted to use his limited time to get effective results predictably. He wanted to save decades of frustration and millions of dollars with the right knowledge for him and his family. He wanted wealth protection, a plan B, and peace of mind. He wanted to be held accountable with an accountability partner to get results. He wanted to have a family office to help him manage his financial affairs. He wanted to create generational wealth for his family. He wanted to have a fully completed, executed wealth plan and investor strategy sheet, and he wanted to get results. Now, if you resonate with Jordan, then I would highly recommend that you implement the plans that Jordan did to help achieve and get the results that he wanted. Victoria, in her 50s, devoted to her family and business, aiming to build generational wealth. She's got a packed schedule, but she wants a streamlined investment strategy that empowers her to make wise decisions, aligns with her goals, frees up her time for her grandchildren and her daughters. She wants to understand the investment landscape so she feels empowered to make the right decisions for herself and her family. And Victoria focuses on achieving financial freedom to cherish more moments with her loved ones. So again, if you resonate with Victoria or Jordan, then I'd highly recommend actually taking the action and implementing and doing what they did so that you can get the results that they got. So why are we here? It's all about diversification across countries, currencies, assets, partners, and time. And what I want to share with you, so I wrote this book 10 years ago, Property Going Global. It was endorsed by Clem Sunter. And this book was all residential. So if you want a copy of this book, I'm happy to give it to you. Just type in there Property Going Global or PGG, and we'll figure out a way to give you this book. But this book is 10 years old. And what I tried to do when writing this book is I tried to make it evergreen, which means it lasts forever. But little did I know that nothing lasts forever. And why I say that is even if you've got the fundamentals and the systems, things change, including my own understanding and my knowledge. So 10 years later, in 2013, when this book came out, I'd only ever done residential property. But from 2014, I started doing commercial property. In 2019, I started doing other alternative assets. So 10 years later, Shane, my partner, said, look, it's time for a digital upgrade. And, not only do we do residential, but we do commercial, plus we do other alternative assets. So what I'm going to share with you today is that if you want to diversify across countries, currencies, assets, partners, and time, today I'm going to share with you, and I'm going to start with, there's effectively 3 different components. You've got residential, you've got commercial, and you've got alternative assets. But I'm going to start today, and I'm going to show you the residential component. I can't do it all today, but I'm going to show you where to get the information. So module 1 is all about the countries, uncovering the global market, where to invest. I mean, it's a big world. You want to play global monopoly? Where do you get started? Our mission is to help investors get 100% clarity on the countries they wish to invest in and avoid the mistakes that more than 80% of investors make. Now, when I originally started this, and if you do or don't know Clem Sunter is one of the top 5 strategists in the world. He's lectured at Harvard. He helped the Chinese government. He helped the South African government. He was chairman of Anglo Gold. I think he is Oxford or Cambridge. I just can't remember which one. And the point being is that he's an incredible human being. And he does these scenario planning. So he's got different scenarios for the global economy, and he's got different flags, and he's got different probabilities. Now, I don't have the time today to go and teach you. As part of Wealth Going Global, there's actually a whole, module that we've done where, you can go and do all the research. This is his latest book. And here's all, I went and researched all his latest articles. There's a whole bunch of articles all over the internet. And I went and, did all that research. And my philosophy in life, if you haven't picked it up already, is to go straight to source. I get hold of the person. I want to interview them. I want to ask questions because I want to hear it straight from source. So anyway, so long story short, I'd been watching him for about 5 years. I'd seen him present at least 5 times. And he does all these scenarios for the world. And we just had the global financial crisis. We had all these issues in South Africa. Zuma had become president. And I was like, what do I do? Like, what's the point of getting all this information and not taking action on it? Like, what's the point of hearing it, but not using it to make decisions? So I know I'm not normal. I appreciate that. There's no part of me that's normal. But the point being is that I went away and I took his scenario planning and I created a 4-dimensional model. And what was interesting is that for about a year, I was too embarrassed to share this model with him. Because, when you do something, you actually don't know if it's any good. And what I tried to do was take his scenario planning and take the fundamentals of property and create a system where I could put data into the system. So you take emotion off the table so that I could make the right decisions as to where to invest. Now, I'm a big believer that, nowhere in the world is the perfect place to invest all the time. People say to me, oh, London's the best place. Rubbish. It has good times and it has bad times. In any asset class, in any country, in any currency, there's the right times to invest and there's the wrong times. But the problem is that most people use emotion, or they use their friends, or they use their family members, or they use their financial advisors, or whatever. They get a lot of or they use the news, even worse, and they get caught up in sentiment. And so my philosophy and my belief system is that if you use facts and fundamentals and systems, then you're going to get far better, accurate information. You can take emotion off the table and you can make better decisions. So anyway, long story short, about a year later, sent this to Clem Sunter and I said, hey, look, Clem, I'm really, really fascinated by what you do. I've taken your scenario planning, I've overlaid it with a 4-dimensional model so that I can make better decisions. What do you think? And he was so kind. He's such an incredible gentleman. And he was so kind and so complimentary. And he was like, Scott, you have to share this with the world. And he said, if you do, I'll endorse it. And needless to say, that was the book, Property Going Global, that came out in 2013. And what was really interesting is that he then went along, and I'm going to show you where to get this, but the fundamentals of property are, you've got economic risk, you've got the value of the property. They always say, the number one rule in property is to buy from a motivated seller. You've got population growth, critical component in any country. Is it growing? So as an example, Japan's property has declined from 120 million to 100 million, and property prices continue to go down. Supply and demand, simple economics, and then rule of law. If you live in a country like India or South Africa, you'll know that rule of law is as important. And you add these all up and you get a risk index. And then on the right-hand side, you've got a return, and you've got yield, which is income, and you've got capital growth. And I use a 70-30 weighting. Someone asked me in the VIP room yesterday, what's more important? Now, obviously, it's different for different people, but I believe that income provides you freedom. And so I work on a 70-30 split between income and capital growth. And that basically gives me my return. So now I've got a risk index and I've got a return index. And what was interesting is that Clem Sunter then helped me design this. So you've effectively got, on the left-hand side, low return to high return. And at the bottom, you've got low risk to high risk. Now, kind of obvious, and that's why it's put in yellow, you want to be in high return, low risk. So this is the graph from 2013. Okay, this is the graph from the book. Okay, and this is for residential property. And what you basically want to do, if you're playing global monopoly, you want to say, okay, well, where in the world is there good value? Is there good opportunity? Now, just as a mantra, that's 2013. Who would like to see 2024? It's only Stain and Diane. So if you guys want to stay online, I can help you. Darren, Tyron, Fern, Jerome, Colin, Jesus, Sharida. Okay, so a couple of you. Okay, fine. You twisted my arm. So the last thing I wanted to show you, I will show you now quickly. The last thing that happened is that from 2013, we got into commercial property, and we actually evolved that due diligence system that I shared with you into GIDS, the Global Investment Due Diligence System. And this actually takes into account a whole bunch of things. So it takes into account currency analysis. Now we're gonna go to currency just now. It takes into account macro country analysis. So again, things like population growth, supply and demand. It takes into account financial structuring, how to find the right partners, the cities, which cities to be in, which sectors to be in, how to do a due diligence on a property, the pre-purchase due diligence, maximizing the investment, etc. It's 10 layers in terms of the process. Now, I don't have time today to go into all of that detail. But what I did want to share with you, and I promised I'd give you the information, is that these links, and Shane, just remind me, where do people get these links? Is it in the resources or because I know we share the links with people?
Yeah, all of these links will be added to the resources by the end of this session. Okay,
excellent. Okay, so our philosophy is to add as much value as possible and to share with you the links, etc., in terms of the process. So I want to show you where to get the best information from my experience. If you've got a better place, please tell me, around the world. So I'm not interested in the newspapers. I'm not interested in hype. I'm interested in facts. So if you're looking at the global markets, I like the IMF, and this is residential, remember, and it shows you the residential markets and what's happening around the world. You can literally go into real house prices, credit growth, income ratio, and everything else all over the world. Okay, so that's a good one. The one I enjoy most is The Economist. I think you can log in 3 times for free, and then you have to pay. So I'm a subscriber. But look how cool this actually is. Okay, so now I want to compare, I don't know, America and England. Okay, I'm trying to decide if I should invest in America or England. So what's interesting here is this goes back all the way to 1970. It's a completely interactive graph. So I can use all the major markets around the world, including South Africa and all of them. And I believe this is the best research I've found in the world, where it takes all the different markets. It takes it from the deeds office, which means it's the facts based on what's being transferred. And I can compare apples with apples, oranges with apples, bananas with apples, etc. So if I just want to choose 2 countries, and you can see here it's from the year 2000, you can see that in real prices, house prices in America are 50% higher, and in England are 94% higher. Okay, what about nominal prices? Okay, so nominal real prices take into account inflation. Nominal prices are just without inflation. So now you can see that prices in America are 129% higher, and in England are 190% higher. But what's really interesting is that that's not really how you should value property. How you should value property is based on, there's 2 things that are going to drive the needle, along with other fundamentals like population growth, like supply and demand. But one of the things that's really important here is the income. So how affordable is the property? So as an example, in England, property is very, very expensive. And the average age of the first-time homeowner is 42. So I bought my first house when I was 22. So an entire generation is missing out on being part of the property market. Australia, exactly the same problem. Many countries and big cities around the world have this massive problem of affordability. Now, if you've already got an affordability problem, it's quite hard for prices to go higher because they already cost so much. So again, if you look at affordability, house prices in America are 6% overvalued, and in Britain are 28% overvalued. And then the final one, which is the most important one, and I learned this originally from Dr. Han Australia, is that any property, residential or commercial, should really be valued based on the income it can return you. So if you own a property or an asset, how much money is it actually paying you? And it's quite interesting because if you take it based on income, then the United States is 15% overvalued and Britain is 39% overvalued. Now, what's so cool is you can go do this for any country. You can do it for South Africa. You know, you can do it for, well, you can go choose whatever country you like. You can do it for Australia. And so you take these numbers and you can literally put them into the models, and it helps you give the answers as to where the properties actually are supposed to be. So what's fascinating, if I go back here, so I've shown you where to get the information. If you wanted to get more, you know, like, right, okay, I've decided I want to invest in America. Well, there's 300 cities in America. So where do you invest? And again, you do the exact same thing. I don't know if you're trying to choose between New York and Los Angeles, real prices, nominal prices, income, rent. You can see whether they're overvalued or not. If you want to go into even more detail and you want to invest in England, there's 7 different indices in England, but the one that I use is Academimetrics. It's not based on any of the banks, because the banks obviously like to kind of give out their own information. And less than 50% of property in England is mortgaged. So you want to work off the deeds office. So Academimetrics is the right one, and they bring out all the stats every single month. You want to know anything about the UK property market, this is your place to go and find it. Okay, if you're wanting to go to Australia, it's CoreLogic, and you can go and get all the different reports. You just go to their news and research, and you can literally get their latest reports. They come out monthly as well. In terms of you can literally go down to everything, property, etc., etc. Sorry, not property, suburb, etc. America, you've got the S&P. So again, this is the property report, and you can literally go and find out anything you want about America. And then, interesting enough, when I wrote this book 10 years ago, it was the ABSA Housing Index. It's now the FNB Property Report, which is where the best information is for South Africa. When I wrote this book, there's 16 other countries that I gave you the place to go and get information. Just by the way, I only found this out on Thursday via James Painter, but got nothing to do with countries, I suppose, but it's got to do with the Fear and Greed Index, which is very useful in terms of knowing where the markets are at the moment. So what's fascinating to me is that I, put all of this information. Now, I want to share a little secret with you, and I want to go in here. So my incredible business partner, Shane, took all of this stuff that I'm showing you, and he built it into a home study course. Because what I've learned the hard way is that I like to teach people all this information, and it can be quite overwhelming. So what he did is he said, look, let's not write another book. I always joke with people, the only person that read the book was my mother. It's a bit of a lie. Lots of people have read the book. But the point being is that, most people read the book, but they don't actually go and implement the information. So Shane said, well, why don't we do it differently? Why don't we create a home study course that actually holds people's hands? So the first module is the power of clarity and getting very clear on your 5 whys. And then you go to uncovering the global markets and where to invest. And this is where I run through the lesson. And then all the materials are here. So you've got our calculator, the global property system, you've got all the graphs, you've got Clem Santa, and then you've got all the different countries. You've got America, you've got growth, you've got population, you've got rules of law. So literally where to find all the different information. I will give you a little bit of a sneak preview here. If I open up the presentation, and I just want to go through here, because I take people through how it all works and scenario planning and residential and commercial. But yeah, residentially, that's where we sit at the moment. But I literally take people through each one of them, where we sit residentially. If you go to commercial, you can see there's commercial. You can see the countries, America and India. And then under alternative assets, I also take them through alternative assets and which countries they should be investing in. So what's fascinating to me is that with this home study course, we literally take you through the process. And then what's pretty awesome at the end is you choose your top 5 countries for yourself personally. So you literally go through and you choose your top 5 countries, your top 5 for residential, for commercial, and for alternative. But we've held your hand all the way through the process. So, you know, what I learned when I read the book, or not read the book, I wrote the book 11 years ago, is that, you know, so many people go and read this, but they don't actually create a system. Okay. And for me, what Shane created was a system to take the knowledge and to walk away with a plan. So if you literally want a plan, you know, he's built it for you basically in terms of this process. So anyway, we've given you if you want to do it all on your own, we've given you all the information and you can have my book for free. So let's go to module 2, which is all about currency. And this is the currency conundrum, managing risk in a global, you know, investment. The mission is to help investors diversify their portfolio and mitigate risk by investing in multiple currencies. So again, when I wrote the book in 2013, you know, they talk a lot about CPI, which is inflation. And I was like, well, what about creating a global wealth index where, you know, whether I live in Singapore or South Africa, I want to know whether my currency is increasing in value or decreasing in value against another currency. Because if I'm going to be a global citizen, I've got to think like that. Surely I've got to think, if I want to send my kid to Harvard, no matter where I live in the world, I've got to have the ability to have the buying power to do that. If I want to go to Disney World, if I want to go skiing, whatever it is, that's how a global citizen should think. And so I created the Global Wealth Index. And just like CPI, which is a basket of goods, normally it's got bread and milk and whatever, I thought with the Global Wealth Index, let's create the same thing, a basket of goods. So I created a family holiday in Disney World. I mean, who doesn't want to take their kid to Disney World on holiday? A skiing holiday in France, a private school in Australia. So like my uncle did, putting his kid through a private school, a Harvard. Now, whether you want your kid to go to Harvard or not, it's a separate conversation. But the point being is that you want to have the freedom to make that choice. And then immigration. You know, where do you want to live in the world? Like, oh, I want to go live in America. I want to live in England. I want to live in Australia, whatever. I'm not saying you do. Again, having the freedom of choice. So I created a basket of goods. And what's interesting with this basket of goods is that I can compare any currency anywhere in the world over the last 40 years because it allows me to see the buying power of that currency. And as an example, if you take the rand to the dollar from 1983 to 2023, the buying power, you've lost 92%. I mean, that's significant. And by the way, on average, you're losing 5 to 6% a year. Now, that's just in the rand to the dollar. But we're going to talk about some other currencies today that are really, really important. So in the module 2 of Wealth Going Global, James Painter goes all into currencies and he explains how they work, what are the hidden engines behind the market, why exchange rates need to adjust. And I want to do a little sneak preview for you. And it's only a 7-minute video. And I shouldn't really do this. Both Alex and Shane said I wasn't allowed to. But James very kindly did a video for our mastermind members last week. So we do a monthly session. And just last week, he did a video for our members. And it's 7 minutes. And I wanted to share it with you because it'll give you some insights into how this man operates. I've worked with him for 15 years. He's got incredible clarity around where the markets are going based on the systems he uses. And one of the things as an investor, I'm quite heavily exposed in US dollars and I need to be in euros. And let me explain to you why. Just watch this 7-minute video.
All right, welcome to our long-term outlook for the US dollar and euro for Roth University Mastermind for April 2024. So before we dive in, obviously just the normal disclaimers. For information purposes, we can't guarantee this, and trading and investment involves risk, we know. But okay, let's dive in. But before we do that, just to give you an overview of some of the science behind this. So just in nature, as you've got annual cycles, and seasonal cycles, monthly cycles surrounding the moon, daily cycles, night and day, and intraday, tides coming in and out. So in human sentiment, we have long-term, medium, near-term and short-term cycles. So how those all work together is if you've got a market with a trend, and you've got a long-term cycle, and a medium-term cycle, and a short-term cycle. What happens if you take all of these and put them all together? So we add all these cycles up, and the net effect of that is this pattern here, which is how markets generally move. Now these can change because the cycles do flex and change in terms of amplitude as well as the actual cycle itself a bit, but effectively what you get is this pattern of a trend and a counter trend and then a trend continuing. So if we're able to understand what these cycles are, it then gives us an idea of what this underlying market pattern is going to look like. So if we look at the dollar index going back into the 1980s, we can see here we've got a long-term cycle in terms of the monthlies. This is a monthly chart. And what that shows is a high back here in mid-1980s, another high 2002, and we've had a high here which has been kind of after this peak, and we're presently heading down into a trough here. So what it looks like is we've probably topped out here, and as you can see we've got a dominant cycle here, which is a shorter term, and then a longer term, both showing the market probably heading down into 2020, late 2025, 26, and a possible another trough about 2030. Then if we look at the euro, it's pretty much a flip side of that. Going back to 1970s, we see a trough here, mid 1980s, 1997, 2001, and then we can see here this one is also kind of extended beyond the bottom. So our cycles, we are expecting that to head up into 2026 sort of area. But then if we actually look at the market patterns itself, a long-term monthly chart, you can see the market has gone up, come down, come up, come down, up, down. And how we are looking at that is that we've had this 1, 2, 3 pattern up and a correction down and a 1, 2. We're expecting a third push up here. So trend, counter trend, 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 counter trend, trend. And what that is telling us that as long as we keep above this 95 level, we could head a little bit down here, but we're expecting the market to push up and break above this 123.50 area and then head towards the 160.38. That is the next key level. Now, in terms of how the market moves, generally we tend to have some ratio between the various waves. So we've got 2 levels above here, which if we take this move up and we extend that, so the trend, counter trend, and then trend again from here, that gives us a next level of 185. But then if we look at the bigger picture and we take this move up, ABC, and we extend that from this level ABC here, that gives us another target here of 215.46. So these are the levels to be watching: the 123.50, then 160, 185, and 250. So overall, that is where we're expecting the market to head. This was our analysis that we published this week, which effectively says we're correcting then further up. The market has retraced, and while there remains a chance of a deeper correction before the uptrend resumes, overall bias remains bullish with a break above 112.76, confirming a move towards 123.50. And a break above that will confirm a large degree uptrend is underway, signaling further upside towards 160.38. And then we've got two levels below that, 101.98, which would delay this outlook, and below 95.36 would invalidate. So that's what we've got for you today. Trust it gives you some insights as to where we're expecting the market to be heading over the next few years. If you want to get a 7-day trial, there's our link there, dynamicforexsolutions.com/go/free-trial. And if you want to get in touch with us, here are our contact details. Thank you very much.
Cool. So just a very short video. Interesting enough, actually, James did a webinar last week for our community on all the global trends. So currencies, commodities, cryptocurrencies, the stock market, everything. Now, I tend to joke with him. He truly is a rocket scientist. He goes and looks at all these models and stuff. But the best way I describe it is it's like looking at the weather. And I don't really care how the weatherman decides whether today or tomorrow is going to be sunny or raining. But they look at all the patterns, they look at all the data, and they give me accuracy. And based on that accuracy, it's obviously not 100%, but they give me much better prediction than me guessing. I can plan my life, which is how I like to do it. So for me, currency becomes really important. So James runs module 2 of our currency schedule. So if you go back to here and I go into currency, James actually takes us through in much more detail how currencies move, what the hidden modules are, everything that we need to know around how and why they work. And then he also teaches us how to read those graphs. And you can kind of see here, you've got the global wealth index and a whole bunch of other things that are all here. So, but what this actually helps you do is you can then choose your top 5 currencies. So, again, our whole thing is action and results. So you walk away with, what are your top currencies based on the information that you're interested in terms of that process. Okay. How are you doing so far? How's the brain? Spinning a little bit? Let's go to the third part, which is the assets. So, now you've decided on the countries you want to invest in. You decided on the currencies you want to invest in. Just by the way, if you didn't understand the graph of what James just shared with you and what he shared with our mastermind members, the US dollar is expected to lose anywhere from 25% to 60%, maybe even higher, against the euro over the next 5 to 10 years. Now, does that mean you should be buying euros or selling euros? Anyone? Buying. Yes, well done, Jerome. Well done, Diane. Well done, Mike. Well done, Linky. Selling dollars, correct. Sharita, yes. Tuleka, yes. So you've hit the nail right on the head. So can you see how this all starts to interrelate? And, now if I'm going to be an investor and I'm going to be looking at countries, America is a good investment. I'm not saying you shouldn't be investing in America, but it's about diversification. I want to be investing in America, but I also want to be investing in Europe. I have to have some of my assets in European assets with income producing, opportunities in Europe, because I want to be exposed to the dollar. Oh, sorry, other way around. I want to be exposed to the euro. Does that make sense? Sorry, I don't want to belittle people, but I also don't want to lose this moment of understanding. Because we're talking about diversification, and I'm now showing you how these things interrelate, because you've got countries, you've got currencies, and now we're about to go into assets. So Assets, building your global portfolio, selecting the right asset for investment. The mission, we will help investors understand the top 15 assets that they would invest in without losing money and spending decades researching them through trial and error. So this is all about the asset classes. Now, the top 15 most commonly recognized assets are stocks and equities, the stock market, bonds, debt securities issued by governments, municipalities, and corporations, real estate, so physical property, pretty much what I got behind me here, residential, commercial, industrial, etc. Cash and cash equivalents, commodities, so raw materials like gold, silver, oil, natural gas, etc. Mutual funds, so pure pooled investors for multiple investors. Exchange traded funds, ETFs, which are invested on stock exchanges. Derivatives, so financial contracts derived where the underlying assets such as options, futures, and swaps. Currencies, so trading one currency against another. Private equity, ownership stakes in private companies not traded on public exchanges. Hedge funds, so investment vehicles that pool capital from accredited investors. Venture capital, so investing in early stage companies. Art and collectibles, so valuables like artwork, antiques, rare coins, and stamps. Cryptocurrencies, digital currencies like Bitcoin, Ethereum, and others. And infrastructure, so investments in essential systems such as transportation, energy, and utilities. So they're the 15 most commonly recognized. Now, in Wealth Going Global, I go into this in a lot of detail. But in simple terms, you've got two different types of investments. You've got a primary market investment and you've got a secondary market investment. A secondary market investment is the one that you all understand generally. It's the stock market. So you want to go buy shares in Apple or Tesla, you literally go on the stock market and you buy shares. They're a secondary market investment. They're publicly traded. They're easy to access. And equally, they're easy to sell because there's a lot of liquidity in the market. A primary market is a direct asset. So you're not investing via a listed entity, you're investing directly in the asset. You specifically own a company, you own a piece of a company, or you own a piece of property, or you own the whole property. But primary market investing is where you invest directly in the asset. And this becomes really, really important because tomorrow we're going to talk about asset allocation. And you'll see that I'm going to share with you, there's a report that comes out every year on the 500,000 wealthiest people in the world. 579,000 wealthiest people in the world. And if I was to tell you that more than 50% of their investments are in the primary market, and then I was to ask you how much of your investments are in the primary market, and I think you'll be quite shocked to see the difference. So the average person, as I said to you already, has 70% in the stock market and 30% in bonds. And yet the wealthiest people in the world have the majority of their money in the primary markets. Okay, Mike says he has 70% of his in private equity. Perfect. So private equity, if we're talking the same language, is the primary markets. Jerome says primary markets investing is the way to go. So it's really, really important to understand these two. Then the next question that people say to me is, well, Scott, what about residential? And by residential, I'm just talking kind of houses and apartments. And I tend to refer to this as mom and pop investing. So it's very important to kind of get out of the rat race. So, if you take $1 million or £1 million, below £1 million or $1 million, there's a lot of people running around, a lot of kind of middle class and professional people trying to buy houses and own them and renovate them. It's a very, very crowded market. And it's mom and pop investing. And generally, there's low returns and a lot of hassle. And so what you got to do is you got to get out of the mom and pop investing and you got to get out of that mindset. And let me explain to you why. So this is something I learned over the last 20 plus years by watching, I've helped thousands and thousands of investors from all over the world. And I started to notice these patterns in terms of this process. So if you take the real estate value chain, the current system, okay, is you and I are over here as the investor and we want to own a property. There's fees all the way through the process. And actually, there are 16 different middlemen. 16 different middlemen between our investment and ourselves. Okay, so that's really, really important. And there's very little trust, there's very little transparency. And because of that, there's high fees and low returns. So this becomes a real issue. And so, the old school way of doing it was that people would say to me, oh, no, but Scott, I'm going to diversify. I'm going to go buy a house in Manchester. There's someone over there that'll help me, buy this little apartment, and I'm going to renovate it, and I'm going to stick a tenant in it. And it's a very old school way of doing it, basically. It's kind of like saying to me, like, I've got a car, and I'm like, hey, do you want to come for a ride in the car? And you're like, no, it's fine. I'm going to jump on my Volkswagen. It'll take me from A to B. And I'm kind of like, the world's changed. The world truly has changed. But what needs to change is people's mindsets, to change away from being this mom and pop investor where you're getting low returns and high hassle, and to get out of the rat race and to think and invest like an institution, a sophisticated institutional investor. And even though you might not have the capital to invest like a sophisticated institutional investor, you can have the mindset, and you can now, using technology, invest like them. And then you get high returns, low hassle. So my question is, do you want high returns, low hassle, or do you want low returns, high hassle? It's really important. Mom and pop investing, low returns, high hassle. Institutional investing, high returns, low hassle. So let me explain to you this value chain of real estate, because this myth is, all of us have gone out and read this book, these property books. Dolph DeRuss says, go look at 100 houses, make an offer on 10, get accepted for 3, buy 1. It sounds great. I own 16 of them around the world. Flipping high hassle, low return. And let me explain to you why. There's a value chain of real estate, and there's 5 main steps. You've got land zoning, you got the developer, you got the investor, you got the fund and REIT, and you got you. Now, in terms of returns, I'm talking IRR here, internal rate of return. The land investor is generally looking at a internal rate of return of about 30%. The developer is looking for 25%, and the investor is looking for about 20%. Now, I have people all over the world say, yeah, but we don't get that. Yeah, I know you don't get that necessarily, but that's the target. That's certainly the target that they're looking for. Then you've got a fund to a REIT. And what's interesting is they're looking for an income of 5 to 8%. Now, if you invest in a pension fund, what do you want? Just type it in the chat box for me. If you invest in a pension, what do you want? So yeah, Jerome, you want passive income. That's exactly it. You want money for your old age. You want income. You want tax-free growth. Okay, fine. That's the government's way of incentivizing you to put money into their system. You want income that can grow over time. You want secure passive income. Yeah, so most people are right in terms of the income side. So what do? They buy secure and stable income. Now, just by the way, I want to make one comment here. Naval said, mom and pop buy-to-rent properties can be leveraged. Can't do that with commercial investment. I completely disagree with you, Naval, because I've been doing that around the world for 10 years. All of the properties that I invest in with partners are leveraged with bank debt. And yeah, so that's a mindset shift I think you need to change. There's a difference, and I'm going to share with you on Thursday how to find the right partners. What I think Naval is saying is, if I go buy a house, I can get a mortgage from a bank and I can leverage it. But that's no different from if I go partner with someone and they've got a mortgage on the property, I'm still getting leverage. I'm just not taking nearly as much risk. Mindset. It's all about changing the mindset. And then finally, you and I come along and we've invested through a listed REIT or something, and we kind of get 2 to 6%, and then we wonder why we battle to beat inflation. So if you think I'm wrong, go to my LinkedIn article, go to LinkedIn, just search, go to LinkedIn, look for Scott Piggin. And I literally put here how wealth is created in real estate and what the billionaires do. And it literally explains this. Now, I've done this now for 28 years. I've watched a hell of a lot of people make money in property. And the single biggest way that people make money in property is they take an asset, they secure the income, and they sell it to a fund. a fund or a REIT. Let me repeat that. The single biggest way that people make money in property is they take assets, they secure the income, and they sell it to a fund or REIT. Now you can go read this article. It's in one of the business newspapers, and it's all about a company called Rebosis, who was the developer that built a whole bunch of shopping centers and then sold those shopping centers to a fund called the Billion Group. I think it might have been the other way around. The Billion Group was the property. It doesn't matter. Anyway, the two companies sold it to a fund and then listed it on the stock market. And then all the retail investors invested in it. And what this entire article was talking about was how the retail investors actually overpaid for the property. So my question to you is, and by the way, I just realized I forgot to take my jacket off. So I've been wondering why I'm so bloody hot today. Anyway, this is me relaxing now. This stuff actually really pisses me off. I'm not going to lie. Because when I realized this, I realized there was a whole nother game going on that, we intentionally or unintentionally we're not being told about. So if you take the real estate, value chain, there's you over here sitting down at the end of the porta potty, right at the bottom. And I tend to say to people, you and me, why don't we go up the value chain? Why don't we invest like an institutional, sophisticated investor? And why don't we own commercial buildings, industrial parks, medical buildings, shopping centers, office parks, you name it, whatever it is. Or why don't we do developments? Why don't we go and, build big developments? I'm not talking renovating one house. I'm talking about proper developments. And my question is, why don't you? Just think about it. Why don't you? And Jerome, you're right. Retail investors at the end of the value chain. That's exactly it. I already told you the stats. 99% of people don't retire wealthy at the age of 65. It's not my opinion. You can love me, you can hate me, but you can't argue with the facts. So having done this, a lot all over the world, I've heard many, many reasons why people don't. How do I protect myself? It's too expensive. It's too complicated. Time and effort. Local real estate's too much hassle. I need the right structures, ongoing management. I don't have time. It's difficult to invest. Too much compliance. I don't know how. It sounds too good. Access to deals. There's too many scams out there. But, in simple terms, and funny enough, M. Pearson just said too much hassle. I have a glimpse of the industry, many cowboys, completely. So, scams, cowboys. But, if I look at it, the three that come through more than anything is, I don't have the time, I don't have the money, and I don't have the knowledge. They're the three that come through the most. I don't have the time, I don't have the money, and I don't have the knowledge. So I tend to kind of use an Uber example because most people have used and understand what Uber is. So in the old days, before Uber turned up, I would have arrived at any airport in the world. I would have picked up my telephone and I would have phoned a taxi owner organization who would have phoned a taxi driver. And the taxi driver, let's just say it was in London, Heathrow, the driver would come pick me up and he'd be about 2 hours later. And then once he picked me up, if he knew that I didn't know my way around London, he would take me the long way. It was a very unpleasant, expensive experience. And obviously, if I lost my cell phone or anything like that, I'd never ever see it again. And then Uber came along, and previously private drivers were only available to the wealthiest of wealthy people. And then pretty much anyone that had a cell phone, a smartphone, could get access to Uber. And what did Uber do? Well, it cut out all the middlemen. So I now could speak directly to the driver. It cut the costs dramatically. And it dramatically increased the trust, the transparency, and the accessibility. Think about that. Increase the trust, the transparency, and the accessibility. So, for me, when technology comes into any industry, it can do the exact same thing. So I tend to say to people, well, this was a picture of one of my work colleagues, and he left his cell phone in the Uber. And, sort of 5 minutes later, the Uber was there giving it back. And that's kind of that trust and transparency I'm talking about. And if that's the case, well, then why can't we use technology to cut out all the middlemen, to cut the costs, and to invest directly with the partner with more trust, more transparency, and more accessibility. And my fundamental belief is you can, and we have been doing it for 10 years. You can invest directly in income-producing assets, or you can invest directly in growth assets. And I just want to read, because there's some comments coming through here that I think are really good and should be answered. So I assume M. Pearson's talking about made this very mistake and being a nightmare. I assume he or she means buying houses. Tell me if I'm wrong. And please tell me if you're a man or woman. Sorry, M. Pearson, I don't know. I don't know whether to call you Miss or Mr. or Mrs. Retail investors. Okay, so Mike said 2.45% annual return between 2007 and 2023 on a residential house about 60 miles north of London in the UK. The house also had a low yield. Yeah, so I think, Mike, that's the point. I've also owned a property since 2002 in London. And, you know, the average yield you're getting in London is probably 2 to 4%. That's a lot of time, that's gross. If you take net and you take off all the costs, you know, you might be averaging, you know, even 2 to 3%. You've got the capital growth, but when you start to compare apples with apples, it's really interesting. And we're going to talk today. Literally, I'm going to interview a guy called Gary, and he's going to explain to you the difference between what I call mom and pop investing, which is buying a house or an apartment, and institutional investing. And he's going to explain the difference, and he's going to explain the phenomenal difference that it'll have on your returns. Yes, Jerome, you do need a mindset change, and that's what I'm trying. So cutting out the middleman is really important. And okay, M. Pearson's a lady. Okay, excellent. So I think Mrs. Pearson or Miss Pearson, you know, this is the point. We were all taught to go buy houses. I did exactly the same thing, so I'm not blaming anyone. I went and bought 16 houses around the world, and it's bloody hard. And I helped 2,500 investors buy houses in England, Australia, America, and South Africa. So I've got a hell of a lot of experience as to what works and what doesn't work. And, you know, for me, I can sum it up literally with my hands. Like, high hassle, low return is residential mom and pop investing, and low hassle, high return is kind of commercial, sophisticated investing. And you know, that's really important. So anyway, let's rock and roll. So what do we not do? Okay, and this is important. So there's kind of 8 golden rules that we don't do. So we don't do assets where you need to pay an expert. So like, this is where if stuff's just too complicated, like, I don't like to do that, because, you know, you're only as good as the kind of that advice. And if I don't understand it, it doesn't make sense to me. So a good example of this was the stock market. You know, the average return is 9.5%, and that, you know, you and I are trying to do it on our own, have only earned 3.5%. The second one is I prefer to avoid assets that have no income, unless there's timing. So sometimes there's a good investment and there's good capital growth. We just invested in one in cryptocurrency, taking advantage of the halving. And I don't know how much you know about cryptocurrency. And that's all capital growth. So obviously, you know, you're building a portfolio. But at the end of the day, you saw my numbers earlier. I would say about a 70% focus on income at least. Assets which are short-term, volatile, and high maintenance. So what I mean by that is like the stock market or day trading, currency trading, cryptocurrency trading, whatever it is. I don't like that. Like, I like to be able to sleep at night. I like to be able to go on holiday, come back. You know, my investments are still there. I'm not saying it's right or wrong. It's just me. You know, I'm not a trader. Assets I don't understand. So things like futures and swaps and, you know, all of that stuff. I know Alex, my partner, really wants to get into that stuff, but, you know, him and I are different types of people. So you kind of got to do what you're good at. And I don't like to do things I don't understand. I'd much rather do things I understand. And you know, the worst case scenario, if I'm doing something I don't understand, I'd find a partner that I trust. Assets which mom and pops do. So again, I believe very strongly in getting out of the rat race. If you want average returns, do what everyone else is doing. If you want below average returns, do what everyone else is doing. If you want to be part of the herd, then stick with all the other cows and sheep. I don't believe in that. I fundamentally believe that using technology now, we can get out of the herd, we can get out of the sheep, we can get out of the mom and pops, and we can invest like the wealthiest people have been doing for decades and centuries. Why don't we just copy them? Like literally, they're getting the results. Why don't we copy them? And we can now using technology. I want to make sure we get assets with the right information. So I'll give you an example. I had a meeting this morning with a gentleman in Singapore. We're about to get into data centers. So data centers are, like, if you think about it, okay, no matter what happens in the world, artificial intelligence, every company is just growing more and more data. You've got cryptocurrencies, got everything. Every single one of those technology companies, in fact, every company in the world needs technology and infrastructure. Yes or no? Okay, well, what do they all need? Data centers. It's like a no-brainer. You know, when they say the gold rush, they say far better than trying to mine for gold, be the person who sells spades. Well, if you think about the next 10, 20, 50 years, what is going to be needed more than anything? Data and technology. But all that data and technology has to be somewhere. So they need data centers. Now, very quick fact here. Data centers use more power, more electricity. So one data center in a month uses more power than 180,000 homes. So one data center in a month uses more power than 180,000 homes in a year. Okay, now, if you're a government or a politician, electricity is a big problem all over the world. Do you want to give out permits for data centers? Think about it logically. Environmental, social, political, electricity. The answer is no. I mean, it's obvious. So supply of data centers is like horizontal because it's very hard to build new data centers. And demand is doubling every 6 months. Kind of common sense. Now, why did I bring this up? Number 6 is assets we don't get the right information. Like I didn't know any of this stuff until 3 months ago. And in January, we invited an expert who we've worked with and known since 2017 to come and share with our mastermind members about data centers. And I've just been blown away. Like I'm all over it. So for me, it's about getting the right information. And then, obviously or not obviously, it's about having the right partners. So I want to get into India. I've been wanting to get into India for a long time. In fact, I went to India for the first time in 2018 to go look for partners. And to date, I haven't been able to find partners that I can truly trust to get, and invest alongside. So sometimes there'll be a market, you'll have the right information, you want to participate, but you don't have a partner. In the data center, as an example, we got the right information, we got the right partners, and we are literally pulling the plug. And we're looking to launch, hopefully in the next month or two, our first data center in Malaysia, our next one in Japan, another one coming up in Austin, Texas, because we've ticked the boxes, the right information. But again, I'm very clearly, I've had people come to me and go, oh, Vietnam is an incredible country, you should be in it. And I'm like, I agree, probably. Southeast Asia is exploding. But I don't have the right information, I don't have the right partners. And then lastly, countries we don't understand. So, again, it could be, the Vietnam story could be a good one. There's great opportunities in that country. We know there are, but I don't understand it. I don't know how to get started there. I don't understand the language. I don't understand the laws or anything like that. And it's one of the reasons why we struggled to get into Europe for a long time, because we didn't have partners on the ground. We didn't understand it. I hadn't done it. In England, I started investing in 2002, in South Africa, 1999, in Australia, 2008, and America, 2012. So, long track records of investing in those countries. But, it's quite difficult to go into a new country and to find how it works and find the right partners and how the laws work, etc. So those are the 8 sort of golden rules that we use. Now, if you take those 8 golden rules and we quickly go back through the top 15, we don't do stocks, we don't do bonds, we do real estate, we don't do cash. I'm not saying you shouldn't have cash. I'm just saying we don't do it as part of Wealth Migrate. We do commodities. We don't do mutual funds. We do ETFs. We don't do derivatives. We don't do currencies. We do private equity. We don't do hedge funds. We do venture capital. We don't do arts and collectibles. We do cryptocurrency. We do infrastructure. Okay, let's look at our top 15 focuses. And Diane said, are data centers an investment opportunity? Yes, they are, Diane. And in the next month or two, we plan to have one live on the Wealth Migrate platform. So these are the type of investments we do on the Wealth Migrate platform. So commercial real estate, multifamily. So multifamily is where you don't own one apartment or one house in America. You own like 300 to 700. So again, it's thinking about it at an institutional level with institutional returns. It's been the best performing asset, risk-adjusted return, since the crash of 2008, 2009 is multifamily. Industrial. So industrial is really important. Again, particularly logistics. COVID happened and, all of the online e-commerce exploded all over the world. They need logistics centers to be able to invest. Medical office buildings. So even though I said COVID had a big impact on medical, it doesn't mean that in the Western world, you've got these aging populations. They're still going to need medical. So, medical opportunities provide great. Office. So again, office, you've got to be careful on where, there's massive vacancies in San Francisco and Manhattan. But the point being is that there are new age office that's taking into account, the way the world's changing and where people are working, etc. There's co-living. So it's not like student accommodation. It's upmarket. It's where the sort of 25 to 40-year-olds want to live. It's living in smaller spaces, but in collaborative environments with all the different infrastructures. It's been one of the biggest and best performing sectors in both America and Europe, and is recently exploding in Australia. London residential. So today, Gary Sachs is actually going to talk to you about London residential and how to do it large scale. So again, this is doing residential in London, which is a great investment, but not buying a house or apartment, doing it at scale. First mortgage debt. So this is where you actually act like a bank, and you take away the risk because you've got security over the property and you're getting an income, but you don't get the capital growth. We just did one of these in Manhattan in December last year. It had a 10.5% return in dollars for 12 months. You got retail. So again, shopping centers. We tend to not do big shopping centers. We prefer to do convenience shopping centers. Our logic is, again, as part of mixed use, that people are always going to need to be able to get access to that type of environment. You got senior living, aged care. So again, a big sector going forward. And then you've got mixed use, particularly as an example, what we got in Germany, where you got multiple different tenants, but it's really that convenience lifestyle kind of shopping center, mixed use, inconvenient strategic locations. And then you got data centers. So I've already spoken to data centers and what the opportunity is in data centers. Okay, ETFs, you've got the stock market. So if you want to invest in the stock market, I'm going to introduce you later to Ann Wilson. I fundamentally believe she's the best in the market at helping people know how to invest in the stock market safely and simply and in the most cost-effective way. You've got structured notes. So structured notes are really interesting. They're a way to invest at an institutional level. Most of us are used to retail returns of like 4 to 6%. At an institutional level, you can earn 10% plus. And people say, well, it sounds too good to be true. And I'm like, well, no, actually, that's not the case. If I show you here quickly. Looking quickly, yeah, here it is. So if I stop sharing here, if you take the banks, like at a retail level, they're kind of used to paying you kind of 5 to 7%. At a wholesale level, it's kind of 8 to 11%. At an institutional level, it's 10% plus. Now, the reason you've never heard of structured notes is that generally you need about $2 million of your own money, cash, to even be invited to this table. And in 2019, I got invited to by one of our clients who I'd been helping invest in overseas since 2011. And he said to me, hey, are you investing in structured notes? And I was like, no, I don't even know what they are. And he explained this to me, and I was absolutely blown away. I then asked our top 100 clients how many of them are in structured notes, and 83 of them were in structured notes. And a number of people came back to me and they literally said, structured notes have been the best performing asset for them over the last 10 years. And I remember sitting there and actually getting quite angry, because I was like, why am I not even being invited to this party? Like, it's not that I'm not investing in this asset. I don't even know what it is. Who here has invested in structured notes? I'd love to know. Mike, yes, co-living does include gyms, restaurants, reception, concierge, everything. Just by the way, if you haven't invested in structured notes and don't know what they are, don't worry, I was there too a couple of years ago. Anyway, it's an investment you need to know about. Gold and silver, I think that's fairly self-explanatory. Private equity, venture capital, and crypto. So they're the sort of the 15 assets that we tend to focus on at the moment in terms of the process. And I can see lots of people saying no, they're not in structured notes. So just as a matter of interest, for our mastermind, we created a thing called Asset Class Mastery. And what we do with our mastermind members is every single month, I invite a partner from around the world. So I've had people kind of turn to me and say, yeah, but Scott, I already know everything. Okay, I'm being facetious, but you get my point. And I'm like, fine, you might know about industrial, you might know about structured notes, you might know about medical office buildings. But what you don't have, and I'm yet to meet someone that has access to all the relationships in all the different markets, in all the different asset classes. And so what my skill is, having done this for more than 2 decades, is bringing partners from around the world that specialize in each one of these asset classes. And so if you take any one of these asset classes, you can see them all here. So this is our asset class mastery. And you can literally go in and you can go to structured notes. It happens to be the very first one. And you can learn all about the asset class and how it works. You can go to medical office building, multifamily, industrial, co-living, gold and silver, London residential, ETFs, private equity, etc. I think you get the point. And so what I want to do now is I want to invite you and share with you a guest of mine, Gary Sachs. Now, I've known Gary, I know I talk about it in my interview with him, but I've known him for a long time. I've been investing alongside him since 2007, 2008. And I really, really think that this is such an important interview for you to understand, because I've been going on all day about the difference between mom and pop investing and institutional. Now, there's 2 major asset classes. You've got property and you've got the stock market. And so today I've got Gary Sachs to share with you how to invest as an institution with an institutional mindset in London. And then I've got Ann Wilson to share with you about how to do the stock market. So without further ado, I want to share with you Gary, because this guy is amazing and he's going to teach you some of the most important lessons you need to know when it comes to property, to London, and how to invest as an institution. Enjoy. Gary, it's wonderful to have you online. Thanks for jumping on. It's always a privilege and a pleasure to learn from people that are on the ground doing it. I always joke with people, we could bring in Harvard University professors and, London Business School economics professors, and they tell us all the rhetoric about what's happening in the market. Or we could do it with someone that, owns hundreds of millions of pounds, has developed billions of pounds, and probably has a better pulse on what's happening in the market. So do me a favor, give us the précis version of your story, how you got to London, and how you ended up being one of the biggest developers in London.
Well, not one of the biggest, but we've done okay. So I left South Africa in 1987 when I was 2. No, I'm kidding. I finished university. I went to Wits, came to England, actually started a little furniture shop. And kind of instead of waiting for customers to come in, I went out looking to all the estate agents, furniture. And just a little bit of history of you own the furniture. So in other words, if the tenant owned the furniture, it was difficult to get them out because their goods and chattels were there. So I kind of transitioned from there to kind of being in the early 90s, was a bit of a property boom. And slowly but surely, I started buying a flat here and a flat there and turning them and et cetera, and selling them. Until that went into developments, and we'd buy a whole development, as you talk about, but we didn't hold them. We didn't have the capital to hold, so we kind of flipped them. It was much easier in those days in terms of getting mortgages, etc. And then we kind of transitioned into saying, you know what, why are we selling this stuff? Can we not keep it? And most of the time we've used our own capital and made it sweat and built up a business that today we are holding nearly 1,000 units with another 300 in the pipeline. And really the basis of this is, I'm sure a lot of you on the call know Natie Kirsch. And in 2009, it was impossible to get debt. And we had a development going up just to the east of Canary Wharf at the Excel Centre where the cable car is. And Natie funded me, and he said to me at the time, he said, Gary, you know, he said, I'll go into this deal. He said, we've checked you out. We think you're honest, etc. He said, but he said, I don't know how clever you are, but even stupid people can make money in property. He said, just don't sell it.
So
and that's very key.
Just repeat it there. Sorry, because I know you well, and you drop these little gems in and people miss them. So just remind everyone what you just said there from one of the wealthiest people in the world.
He said to me, he said, Gary, I'm not worried about doing this deal with you because even stupid people can make money in property. Just don't sell it. Which is great. You know, you have to generate capital to keep on building. So, you know, you can get to a point where the market gives you a lot of luck, or you can create equity by, for example, planning plays where you buy a piece of land and you get a planning permission, etc. It's just the higher risk stuff that creates equity. And then you've got imputed equity. And that's how we've done it up to now. And in fact, now we're kind of looking at external capital to come in and to fund us. And that ultimately is where we're going. So you have to understand there's been a transition in England. England's famous for saying, you know, your house is your castle. And that's always been, you know, people always trying to buy their own property. Just to give an idea, in England, home ownership sits at about 65% of the population, which is enormous. That is absolutely enormous. But what's happened, and it's happened in the world, is as costs have gone up and as prices have gone up, it becomes more and more difficult to buy properties. It was easy up to the financial crash in 2007 because credit was available. As credit tightened up, it became very, very difficult to buy property. So there's been a transition to rental property. Now, that really comes down to the credit markets, because if you think about it, rent is the ultimate form of credit. Okay, so, you know, if you go back 60, 70 years ago, the first consumer credit was really on cars. And that was because the car manufacturers making a huge margin. How do they get more cars sold? Is they offer credit. Okay, so, you know, and as long as and then they're actually making money on both sides. They're making money on the margins of the cars and on the credit. So what's happened in England is as prices have gone up, credit and credit has tightened up, the rental market has increased. Plus, I think it's included as a general world position of more of a nomad generation where people want to be flexible, want to move. I would guess that out of choice, people would prefer to be homeowners, but they justify being rentals, having a rental, being in a rental because they kind of think it's kind of trendy, etc. And you can kind of get more value. What you don't have to do is invest in a massive deposit. So actually, over a life cycle of someone that is renting on a cash flow basis, it probably works. You know, if you offset the additional rent you're paying to what it might cost you on a mortgage, and you take the cash flow of the deposit, it's probably about break even. But what that's created is it's changed the rental market in the UK quite dramatically. So from moving from single, maybe a portfolio of 4 or 5 units as people see as a pension for themselves, which, as you alluded before, starts becoming a nuisance to run. And that's mainly because if you have a portfolio of 5 and one tenant doesn't pay rent, you've got a 20% hit on your
Well,
portfolio.
even worse, most international investors have a portfolio of one, and then if that tenant
Oh,
doesn't
correct.
pay, they're
Correct. So
in
Scott,
trouble.
if you go back a few years, we kind of pioneered rental guarantees.
Yeah.
And the reason we did rental guarantees was not so much and this, by the way, is when we were selling stock. And the reason we did rental guarantees was not so much to get better prices on our properties. It was to give the confidence, okay, to buyers that they knew their cash flow was secure. And so if you think about it, we had a development of 100 units and Joe Bloggs bought 1 unit and Dave Smith bought a 2nd unit. One of them would rent out first and one of them would rent out second. One of them may have a tenant paying or not, etc. So if you do that over 100 and you consolidate that on, say, a rental guarantee position, that risk is reduced dramatically. Okay, so and reducing the risk, and what you really want is investment in property. You've got to understand property is a long-term investment. If you make money on property in the short term, it's because you're lucky with the market, and you can't predict that. You have to actually be lucky. You can take certain factors, which is what we're doing, and kind of use those factors to your advantage. So, just for example, like we're noticing now, there's a huge lack of supply. So one can turn around and say, well, if you look at a macroeconomic position.
Well, if you don't mind, I'm actually just going to chuck up a slide of yours from when you presented in August, just while you're talking about this, just so people can actually see what you're talking about.
Oh, okay, fantastic. Okay, so we've kind of adopted a kind of a macro policy on the basis that you've got to look at 10, 15 years on property to really get your income. Otherwise, you create a market risk. And we kind of saying, well, use what we understand to reduce that risk. We're all about risk reduction on the basis that even stupid people can make money in property, just don't sell it over the long term. Okay, and don't get me wrong, if we get offers on properties that are fantastic, we will sell, but our preference is not to. And also, by the way, you reduce a lot of frictional costs, but I'll come back to that. So we take the macro philosophy on property and say, well, demand is restricted. So if you think about it, what we've gone through since 2007, we had a financial crash. The markets really dipped, but they came back quite strongly because there was a huge wedge of cash waiting for a dip market. And we had a good run between, say, 2012 and 2016. We kind of then started tightening up. Then COVID came, reduced construction. No new developments were really started during COVID. We finished a 700-unit development throughout the period of COVID. So we were very fortunate. Cost increases went up dramatically. So viabilities that developers had done stopped working. We then moved into this high interest rate environment. And for those of a similar age to me, which probably not that many of you there, but I lived in South Africa at one stage with 25% interest rates. So the generation that exists now is very used to low interest rates. I don't believe interest rates are going to drop for another 2-3 years. And I don't think we'll see for a long time that 1-2% positions. So that has dramatically stopped supply. It's particularly in London. And by the way, Scott, as you know, we're London-centric. Okay?
Yeah, well, I was about to pivot. Once you finished on the fundamentals of supply and demand, I was actually going to pivot to this one of why London, because again, it's one of the capital cities of the world, but I'll let you talk about it. But ultimately, I don't think there's many investors that don't want at some point say they own a piece of London.
Yeah, look, the benefit of London is the stability of the legal system, okay, or of England as a macro. As a micro, everybody really wants to be in London and England. If you look at the demographics of the country, there's this huge kind of swathe up north, etc., and there's this kind of leveling up policy. But the truth is, people live out of London on the whole, in places like Birmingham or Manchester, because they can't afford London. And what you're finding is London is equalizing with those areas, because there's been a bit of a boom in Birmingham, Manchester. But what you find is in a down market, and that's how we plan. We plan for a down market. So if we can't make something work in the bad times, we don't want it. Okay, so and so London is pretty strong, and the shortage in London is dire. So just to give you an idea, London needs about 60 or 70,000 new units per annum, and I think like the average over the last 5-6 years is probably 18, maybe 20,000. So it's created a real shortage. That's when Scott was you talk about co-living. So co-living is happening. There's what can happen is you can get smaller units. So what happens, you get like a unit going, an average unit, say 650 square foot, 700 square foot becomes 300 square foot. The only problem with a unit like that is you can only sell it for the income. You can't get any capital growth because you can't split it. So you have to sell it as a building. What we've opted to go for is a mixture between the two. So we are taking regular blocks, which can be split up, but consolidating them. And the theory behind that, having dealt with the macro side of why we're doing it, the theory is, how do we reduce frictional costs? Okay, so when you're a developer, you're going to develop, and if you take your cost, the general margin, profit margin for a developer is between 20 and 10%. Okay, so let's just talk, say, 15% profit on the gross development value, the GDV of the development. So as a business, if we can be vertically integrated, that 15% margin is we keeping. Now you take out the frictional costs. We don't have sales costs. That's going to cost the developer 5% of any development. We don't have further stamp duties, okay, to hold the stock. So if I sold an individual property to an individual investor, they're going to be paying me my 15%. They're going to be paying 5% of the cost that I've had added on for sales costs. They're going to be paying stamp duties. You know, it doesn't take you long to get to 18%. And then when you take the margins at 18%, that's quite a big difference. We also in an environment, obviously, where we've got increasing costs, okay, and a limited land supply. So for anybody that understands basic economics, sorry, if you don't mind, I'm just going to close the door because my dogs are going crazy. Just bear with me.
No problem. So just a couple of things to simplify what Gary's saying. In simple terms, when he's talking about cutting the friction costs, what he's saying is just cutting out the middlemen. And if you remember where I showed you the value chain of real estate, I said you could be investing at the end, which is what Gary's just saying, with all these costs all the way along, and that dilutes your return. That's why you never get out of the middle class, because your returns are middle class returns. Or you can go up the value chain, cut out all the middlemen, and that's exactly what Gary's talking about.
And of course, by the way, Scott, you're reducing the risk, as I said before, because you've got a development of 100 units, okay, and you're going to have a small percentage of bad debts. I think our non-payers and our voids run at about 1.5 or 2%, which is very low, very, very low. So we're running, as you know, we actually have just sold it, but we owned an estate agency, which we started from scratch, called Life Residential, where we manage the properties. We sold it last week, actually, but we were running 5,000 properties in London. And I think our voids were like 45. You know, it was unbelievable. So, you know, everything is kind of brewing to make a really good cup of coffee in the residential market in London. Okay, so what you're finding is there's a lot of capital coming in for what they call build to rent, BTR, so kind of professional landlords. What that's done is it's increased the quality of the properties to some degree, but it's also increased the prices, because what happens is now you've got commercial competition. So I'm building a building, I need to put in a bloody nice gym, I need to make a community that people want to live. So it's all about customer retention. And suddenly, instead of us being a landlord, we're actually we're a business with customers. So we don't have tenants, we have customers. And we treat our customers like hotel guests. Of course, that's got slight increase in costs, but the relative cost increase is far less than the relative rent increase we can get, because people feel part of a community, they feel valued, etc. And and that's kind of the direction that we have gone and that we are going in. Okay, so we're trying to, and then the risk profile of the development, of course, is what you do. Do you buy a piece of land and take the risk of getting planning? And you must understand, when you do that, if you don't get the planning, you've kind of lost your money. You've got a mini field. Okay. If you can get that margin, That's how you make your most margin. So, you know, it's a risk return. The development risk we don't really see as a risk, because we tend to close our contracts in terms of the construction, etc. So just to give an example, through COVID, again, we built, as I said, we built the tallest tower in West London, 57 stories, 700 units, and that was constructed through COVID. And believe it or not, our entire cladding came from Wuhan. Okay, so you can imagine our kind of blood pressure when COVID started, but we closed the contract with the contractor, so we had zero cost increases. In fact, we agreed to pay, I think, on a £200 million contract, we agreed to pay $1.5 million, and that was shipping costs, because shipping containers went up hugely during COVID, and so we agreed to pay some of the costs. And that was just a gesture of goodwill because of the amount of business we do with the contractor. And the Chinese cladding company also took some of it. So we kind of reduced that risk. And so the development risk we're quite comfortable with. We're super comfortable with the rental risk, because the supply and demand, it's going to take, I don't think it's soluble, actually, or solvable, actually, is the word. It will take 20 years at London at full capacity to build, to catch up, to actually provide the stock. The planning system in England is so bureaucratic and so difficult to navigate. And just give you an example, when I say about costs and difficulty of planning and restriction of demand, as you know, very sadly, there was the fire in London at Grenfell Tower. Now, the fire at Grenfell happened. It was a perfect storm. The building had bad cladding put on, it had no fire sprinkler system, etc., etc. So if you compare that building to one of our buildings, completely different. It's chalk and cheese, right? So we have full fire. In fact, we have the highest possible fire rating in our buildings. But what, in their wisdom, they decided to do was to say to anybody building a tower, and it went from 18 meters, from 30 meters and above down to 18 meters. Now, think about 18 meters. That's not that tall a building. That's like kind of, I don't know, 7 stories, 6, 7 stories. And they said, right, you have to have a second means of escape, a second staircase. Now, the rules in a tall building from a fire perspective is stay where you are, because you've got a fire system that works and that functions individually in every single room in our building. So obviously they kind of cracked a nut with a sledgehammer and decided to put 2 staircases. Now think about what that happens in a building. You're just taking out 10% of your usable space, which increases the costs. So you have a situation where a lot of developments aren't viable, and a lot of architects have had to go back to the drawing board and redraw up. So that's just another addition to the restriction on supply. So when you look at it like that and you say, okay, we've taken out we understand the development risk, we understand the rental risk, we understand about taking the frictional costs, you can start working to getting a fairly decent return. Now, the cash and cash return starts becoming damn close to what the banks are paying now. Okay, of course it's not liquid, but it's a cash and cash return. And I keep saying, I have friends that come to me and say, you know, we've done okay in the property business, can we buy a flat for our kids, etc. And I always say to them, I say, you have to understand, I'll send you the flat, I'll give you the biggest discount I can, but you have to promise me, okay, you're going to keep it for at least 10 to 15 years. And I say to them always, and just to be sure that there's no misunderstanding, I'll give you a guaranteed buyback in 15 years at the cost you're paying today. So you cannot lose money. Okay, the absolute number. Of course, you're going to lose the income, but you cannot lose money, because that's how confident we are in terms of the prices going up. And you just have to look, you know, when I come back to South Africa, I just think of a place like Shelley Beach, where my parents had a timeshare in 1980. Say 3, there was nothing there. There was a row of townhouses on the beach. Now there's a whole city. Okay, and that's like over a period. And the same is happening in London. You might be able to show a couple of the slides of what I'm talking about, Scott, about the regeneration.
So just before we go to regeneration, Gary, I want to go there. But just before we go there, there's a question from Stephen, and I think it sort of sums up with this slide I wanted to show. So when you're an international investor, the first thing you get offered often is Birmingham and Manchester and Liverpool, and there's lots of students and they need lots of student accommodation. and developers kind of sell to them. And I mean, I've heard this story. You and I have been doing this nearly 20 years together. And I've heard this story so many times, and I'm virtually almost yet to find people that make money doing this. I'll never forget in Manchester, where 100 South Africans bought, student accommodation, but it was 20 miles. I mean, that's like 36 kilometers from university. And when I was at university, trust me, I didn't want to live 36 kilometers from campus. Like, and needless to say, they couldn't rent it out. Like, you know what I mean? So these things all sound a hell of a good on paper, and then you have real life happening. And I just want to kind of reiterate, I've got a question and I've got a comment and a question for you quickly before we go to the regeneration. This for me is the difference between what I'm going to call that mom and pop investing, which is where I can't afford London. So I tell you what, I'm going to go to Liverpool or Manchester and I'm going to buy an old house and I'm supposedly going to renovate it long distance, by the way, which is now impossible. Then I'm going to manage it. Then I've got one tenant with one, management agent, hopefully going to get it. And there's all these risks. Or I could invest with a partner that literally is building the development, is owning the development alongside me, is managing the development and cutting out all the middlemen. And that just, I want to try and explain to people, that's the difference between what I call mom and pop investing and institutional investing, which is what Gary's trying to explain. I don't know, Gary, if you've got any comments on that before we move to the regeneration.
Well, just reading Steve's question. So Steve, you're quite correct. There's been a huge flood of capital into the student market here. And it kind of defies belief, really, with the amount of quantity that's happening. But what you find is that people jump on a bandwagon, and eventually there'll be oversupply. But people doing that are competing with funds. You've got massive American funds. You've got massive university endowments that are buying these properties, and it's difficult to compete with them. So, yes, you're getting a return. The capital returns on a student development? Here's a very subtle point you have to understand, okay? The returns on a student development are purely based on income, okay? So let's just say, for example, you've got income at 5%. You've invested £1 million, right? You've got income at 5%, so you've got 50 grand coming off your investment. That money is valued purely at a multiple of an investment. So if the market and the cap rates on student accommodation is, say, 4%, you'll get a multiple of 25 on your income. Okay, and if interest rates go up, that will reduce. Okay, you might be expected to get 6%, and then you've got a multiple of 15.5, whatever the case is. Okay, so on residential property, you have the income. The value you can also sell because of the build to rent market. You can also sell on the cap rates. And by the way, if you look at any of the cap rates in the UK, residential property is the best cap rate and the most stable cap rate right through COVID, right through running between, at one stage, 3.25 to now it's sitting at 4, whereas like the equivalent commercial is sitting at a cap rate of 6%. Okay, so the multiples are much more. But if you split up that building, you can also get the capital growth. Now you're talking about price per square foot. Okay, so income is generally based not on price per square foot. It's based on the market, etc. Price per square foot often has no correlation. In a buyer's market, has no correlation. I mean, I've been in an exhibition in Hong Kong when we, 20 years ago, where we'd go in and we started on a Friday selling properties at £650 a square foot, and by Sunday we're selling at £800 a square foot. Okay, which is like ridiculous. So that is the one fundamental understanding of what we do in terms of rental. Okay, so your exit and your IRRs on exit can be much, much higher than say what a student ultimately can be. Okay, a student accommodation. Very stable, great business, and there's been a huge surge. If you just look at the planning applications, people are planning a student and co-living, but it's really simple. Why? Because they're smaller units, and you're going to get higher income on a smaller unit. You're going to get relatively more on a 1-bed flat as opposed to a 2-bed flat from a cost perspective. Okay, but how do you sell that? You can only sell it based on the income. So you're not getting involved in property, you're getting involved in capital markets. Okay, and the people that should really get involved in capital markets are banks, funds that deal in money. And for the individual investor, you're not really dealing in money. You know, you're not saying, oh, I've got £50 here and tomorrow I'm going to invest it here and then I'm going to put it there, etc. You have to look at a long-term strategy. Our strategy actually is so simple and so old-fashioned, but it works. In fact, I had a guy I know, a big agent in London, said, you know, Gary, I've known you for years. He says, you're one of the only guys that I know is still doing the same thing you were doing 25, 30 years ago. But, you know, it's kind of old-fashioned, landlord and tenant, but do it in a much better way. I recommend a really good book, and the philosophy that we look at from a tenant perspective is the guy that started Four Seasons Hotel, Isidore Sharp. And he has a great biography, and where he says, put the customer first and foremost, okay, and everything else will follow, okay? So, sorry, Scott, and one other thing that we do is we tend to fix our interest rates. Okay, so in the good times, we kind of fix them. In the bad times, we let them float. Risk reduction. That's all we do, risk reduction. We don't expect to make massive money, but we will. When the markets boom, we will make a lot of money. But we make very solid returns.
Couple of comments there. You've just taken people from a you know, school level to an honors degree to a master's to a PhD talking about cap rates and everything. You know, I'm sure for
Gray
some
hair
people
here.
went straight over their heads. But my point being is that it's that type of stuff where not only in the VIP, I'll go into a lot more detail if people want to understand it, plus wealth going global. Gary, I want to come back to the fundamentals. And one of the things that I've learned from you and been part of with you is focusing on regeneration areas. They talk in property, location, location, location. But equally, they say in property, try and buy property with a twist. So talk to us a little bit about just, you know, and I can put up the slides for you quickly. You know, I don't expect people to be able to read all the slides, etc. But the point being is that if you want to just talk to us a little bit about the fundamentals of regeneration, and then also why you're now in West London and what the opportunity is in West London.
Okay, so the reason I'm in regeneration is because I could never afford to buy stuff in established areas. Okay, I could never create value. Whereas in a regeneration area, you can kind of create value if you have the vision. And that's one of the things about my experience when I mentioned about Shelley Beaches. When you leave somewhere and go back over a period, you can really see the growth. So if you go back to Sandton, for example, 30 years ago, there was nothing. And if you go there now, it's unbelievable, right? So,
well, I mean, you've got a good picture for.
Okay, so correct. So that's kind of on the left. On the left was kind of when I kind of came to England, and I kind of liked Canary Wharf because you could go and rent something in an established area, was a bit old, a bit damp, etc. And yet you could go to Canary Wharf and rent something that's fantastic. It goes back to how the customer feels. Okay, and then we admittedly we rode that. So, and East London, the history of East London was it was seriously bombed out during World War II, and people and so it created a great opportunity. The buildings were built to a large extent because in the first instance it failed. Why? Because the infrastructure wasn't there. They hadn't put the tube line in, etc., etc. It's ultimately done. It's unbelievable, the growth and the change. So we kind of looked at that, and we happened to be based in West London, and West London is going through a transition. And West London actually is a bit of a no-brainer because it's much closer to the center of London, okay, than East London. But we were given a gift in the fact that they decided to build, I don't know if you guys follow the UK news, but you would have heard a lot about HS2 and it being cancelled. So HS2 is the high-speed rail link, which they were doing between London, Birmingham and Manchester. And in fact, they've just cancelled. It's gone so much over cost that they just cancelled the Birmingham to Manchester route. So we've ended up in a situation where we have the largest station. On the left is what were shunting yards. And now you can see on the right, and I could give you an updated photograph. It's ridiculous, the amount of construction. And so there's become a whole town centre. So we are in this location, we are by far the best connected position in London. So we are in zone 2. So imagine zone 1, zone 2, zone 3 of the tubes. Canary Wharf is zone 3. We're in zone 2, so we're much closer.
There's a map.
And
just find your map. There's your map there, basically. Just to
yeah. So if you kind of point out where West London, White City, you go a little bit left, stop a little bit left there, stop there. That White City, you may have heard of White City, a massive development, the largest shopping centre in London. And then you've got to the right Westminster, and then you've got Canary Wharf. But the point is, in West London, the infrastructure is there already, because the Elizabeth line, which runs east to west, comes straight through there. And then you've got HS2 and the tube. So that's why they chose the location, because it's where all three transport facilities meet. And so the infrastructure is there already. So, and we kind of pioneers, if you're just looking at that picture that Scott has on the right-hand side, just to give an idea, this picture is taken from the 57th floor of a building that we've built. And if you look at the end of the triangle, but to your left with your mouse, that's another one of our buildings being built. That's going to be ready in April. We have another one across the road. That's investments I'm talking to Scott about getting involved in, which is up to a third floor to be ready in about 18 months, 19 months time. Imagine in that triangle is going to be the largest single station in the whole of Europe, not in London, in the whole of Europe. Okay, so anybody coming from Birmingham will be ending up there. So you've got regeneration. And in fact, Scott, yesterday, you might well all know Ballymore. Ballymore, in my opinion, are the best developer in London. They create the best infrastructure. Well, just to the right of that development that I'm saying there, just if you go up, that, by the way, that big green area is called the Scrubs. It's like the third biggest park in London. And if you go just slightly up from there, there's a bunch of brown buildings. There you go, left, right there. Ballymore has just announced they've done a deal with Sainsbury's. They're building 2,500 units there. Okay, so if you think about what's going to cost them to build, if you think about what our cost is because we're out the ground already, and you think about the change in the area, that growth could be huge. Okay, so here's this investment philosophy. Okay, so we're taking something which works today and giving you pretty good returns. That, by the way, what you're seeing is, if you look in the right corner, you can see the building before we built the area and what we built. That's a great sign of regeneration. And if you can have the vision to say, where, so Scott will tell you, a lot of people, when I started building that building, they said, you're crazy. Now they think I'm a miracle maker. So this picture that Scott has got up is we are built now. The three orange buildings in front is Imperial College. Okay, they've got planning permission, they're about to start building. So that whole area is going to transform. All that area that you can see behind is part of the HS2 redevelopment. That's all, and the stations, all part of the HS2 redevelopment. So here's the investment, okay? We know, and we work on current rates, current rents versus current interest rates to make a return. You might not get the 6, 7, 8% return on cash and cash. You're probably going to get net 4.5% return cash and cash. But think about the massive growth between now and 15 years with the regeneration, where all of a sudden you're sort of in central London, because central London is going to move towards the west because of the density levels. So, and at that point in time, unlike student accommodation, you could choose to break up the building and sell individual units, and think of what the cap growth is. So over the period, the cap growth is there. And we all have to look historically, how did our parents buy a house for £10,000 in 1960 foot that, okay, and then end up with a house that's worth £2 million today? How did that happen in a relatively short space of time? So, you know, I think that it's quite a subtle understanding to say. So my view is, if you'd say property as a long-term investment, you buy efficiently through reduction of frictional costs. Okay, you end up and you hold it. You just have to hold it. And over time, you can grow it. It will grow naturally through supply and demand, increasing population. Okay, as they say, God has closed the factory of land. He's not building any more land. Okay, he's closed that factory. So supply is going to be reduced. You've got increasing costs, etc., etc. And then you've got the addition. Okay, you have the absolute addition of the regeneration factor. Just where my per square foot cost today is not going to show any relationship to the per square foot cost in the different place, a bit like a place like Santon becoming from going from one price to another price over a certain number of years. And that's really the philosophy of the strategy. And as I say, we've always tried to do it ourselves and sweat our capital, but obviously you can't keep holding property without sweating capital unless you can get credit. So, and that's why we're looking to kind of consolidate and make a fund. This what you're looking at now, by the way, is our platform for rentals, etc. Okay.
I'm just sort of showing people because they call them trophy assets, you know, aspirational, whatever you want to call it, and it's like so many people, you know, Gary. Even when you and I were doing this 15 years ago, it took a hell of a lot of money even to buy one apartment. And then you had to go set up an offshore structure and you had to get a mortgage and then you had to manage the property and the hassle and everything in between. And, you know, what I love with what you're saying and in simple terms is that in the past, you used to, you know, I would help work with you, but we would help someone buy an apartment and then they were kind of on their own, like go and own this apartment. Yeah, there'll be a management agent, whatever, but it's kind of yours. Nowadays, you can partner with you in the development, you're owning a piece of the building, I'm owning a piece of the building, you know, Joe Soap's owning a piece of the building, and we're holding it for 5-10 years, and you've got a full management solution, cutting all the middlemen out, which obviously is increasing the return, reducing the risk. And, you know, when we exit, there's multiple exit strategies, whether it's selling them off individually or selling them to an institution or whatever. I mean, have I summed it up, you know, in simple terms for people?
Yeah. You know what? Can I give the bottom line? We're in the business not making money. We're in the business of not losing money. Okay, so we start off with the premise we don't want to lose our money. That's the first thing. So if we break even, we're happy. We know that we'll make money over the long term. It just depends how patient you're prepared to be. Okay, and that's the fundamentals, right? So one of the biggest frictional costs now, of course, is finance. Okay, if I can be a cash builder and developer, okay, we're probably paying 10% for our money just on the development side. So if you start stripping it back and you're cash and you've got a group of investors and you're building for cash, okay, the margins are enormous, okay, but over a longer period.
Yeah,
the IRRs become huge.
Well, look, I've squeezed more time out of you than I asked for. So you promised to give me 15-20 minutes, and Cheryl said, "How can I get in touch?" You know, Cheryl, between Gary and I, we're going to be putting an opportunity together. It's going to be on the Wealth Migrate platform. People will be able to invest directly alongside, you know, with Gary and the team from a partnership perspective. So yeah, just watch the space. It's literally funny enough. While Gary was on live, Ian Cohen, his partner, was phoning me, going, "Hey, we need to do the numbers because we were having a meeting yesterday about the numbers." So it's a work in progress in terms of where we're going.
Scott, there's just one question I just saw from Caroline, just questioning on overvalues and what is the value of a property. So Caroline, my belief is the value of the property is the income it produces. Okay, that's very simple. You know, if it doesn't produce an income, what's it worth? It's worth whatever anybody will pay for it because they fancy that property. Okay, with residential property and the liquidity of residential property, it's worth what the income is in today. But you know what? At some point in time, there'll be someone that wants to buy that property from you for an inflated price.
You know what I love, Gary? You weren't on an hour and a half ago, and I literally started an hour and a half ago, and I showed them all the international markets, and I said, whether you own a house to live in or you own a house to rent, it should be based on the income of what you can get for it. So the nice thing is,
Scott, interestingly enough, the people that buy the house to own to live in, it doesn't matter. As it's your home. As long as you're happy there and you can afford it, doesn't matter. And that's why people pay. So if I've got a really nice home, someone will buy that from me at an inflated price because there's a real value to that. At this moment in time, majority of the market is just income based.
Yeah, no, brilliant. Listen, I'm going to bounce. Thank you very much for your time. I really, really appreciate it.
Absolute pleasure.
A hell of a lot of questions.
I hope your weather is all better than mine. It's cracked London.
There's a hell of a lot of questions that come up. Shane will be taking them all and I'll be answering them in the VIP room. But this, I'm sure, will not be the last time Gary and I chat. I always joke with people, him and his partners pioneered furniture packs and rental guarantees and, you know, and everything 25 years later so that international investors could get into the London market. And what I'm really excited about is with him pioneering this buy to let space or buy to own space using technology now, and it's going to be a game changer for everyone. So thank you, Gary. I'm really excited.
And if anybody ever comes to London, feel free to contact me and we'll take you around, show you with pleasure.
Awesome. Keep on, mate.
Cheers, guys. Thanks very much. Bye. Bye.
So what do you guys think? Starting to decide whether you still want to be a mom and pop investor? Just a couple of questions that came through. Shane sent me one. And let me pull it up here quickly. So I know there's a couple. So Naval said mom and pop buy to rent properties can be leveraged, can't do that with commercial investment. I did answer that, I think, already, but you can. Every commercial investment I've done since 2010, and we've done over $100 million in equity and $1.3 billion in deals. Every single one has been leveraged. Every single one, except for the Manhattan deal where we provided the first mortgage debt. So we effectively were the bank. Every other deal has been leveraged. So please, it's not, we need to change that mindset. Right, let me look here quickly. There was another Q&A that I quite liked. How do you figure out your investment strategy? Can your personality fit play a role in this? Jerome asked that. So Jerome, it's so interesting you say that. I don't know if you know anything about the Enneagram. Your personality can certainly play a role in it. And one of my dreams, and I'm going a little bit off track here, but one of my dreams has always been, you got a smartphone, okay, and you got smart investing, you got a smart watch, you got a smart TV. Why couldn't we have like smart investing? Okay, so what I mean by that, like just take Tinder. Everyone's heard of Tinder, I assume. Tinder's like a dating app. Like it just matches two people together because they got likes. It's not even really complicated technology. And so why could you not do the same thing? Why could you not do the Enneagram, which is a personality test, and it teaches you all about like who you are and what your needs are and whether you're risk averse and all that sort of stuff. And what about if it could marry together the investments that suit your requirements, and it marries together your wealth plan, and it helps you make the right investments for yourself. Now, everything I just said already exists from a technology perspective. It's just about bringing it all together. And the best part is I know there's a couple of people that are on the mastermind already. I know Micheline's on the mastermind, and Fiona's on the mastermind. Who else is in here? Let me just check quickly. I know there's one other. Sorry, I'm just missing you. Where is she? Anyway, the point is there's some mastermind members that are on here. And next week, we actually have a lady that specializes in the Enneagram. And for our mastermind members, she's doing a private session where she's going to be running through the psychology of money, how basically our profiles are tied to our investment strategies, how that works within our relationships, within our family dynamics, how do we build generational wealth and legacy, all in the financial space based on our Enneagram and our profile. And what's really, really interesting is that, you know, as a family office, and I'll talk more about this tomorrow, as a family office, that's what they specialize in terms of, you know, generational wealth, building legacy. You know, it's not only about protecting the capital, tax and structuring, but the bigger picture. And they do this for all of their clients. And my attitude's always been, well, they got 65 to 70, like very, very wealthy families that they look after. Why do we not copy those strategies and provide it to all of our mastermind members? So that's exactly what we do, Jerome. And, you know, really interesting. And you can start to see, like when you talk to Gary Sachs and listen from Gary Sachs, the mindset's at a very different level. You know, you and I are out there, we go and read these books, Rich Dad, Poor Dad, and we go on courses and, you know, blah, blah, blah. And they all teach us, go buy a house, you know. And why? Because it's easy, okay? You know, Naval's like, yeah, it's easy. I can go get a bank or mortgage. Yeah, you can. Well, to be honest, you can get one in your country. It's very, very difficult to get one overseas nowadays. So this is a much, much easier way of doing it, a much safer and simpler way of doing it, but it takes a mindset shift. So, yeah, I don't know if that answered your question, Jerome. I can see we're on the hour. And so I just wanted to be conscious of time here. I could talk for hours about this. Gary Sachs is surname, Micheline. Fern says, oh, no, mom and I thought you said, Fern, I thought you said mom and pop investing. This is the way. I was like, wow, you seem to have just missed the whole last 40 minutes. Anyway, I'm glad you did. Okay, cool. Let's rock and roll. Sorry, I love this stuff. Like, I wish I could share it with more people, quite frankly. Okay. So asset class mastery, it just gives you an example. So I'm just giving you an example of two of the partners that I've introduced to our mastermind members, one of them being Gary Sachs, who did that special interview for you guys. And the other one that I want to give you as a gift is Ann Wilson. So Ann Wilson's one of the most incredible people I know. She's an incredible teacher around money and finances. And she did a special recording for us as well. And if you go to the resources, you can actually see the recording. Now, I'm conscious of time now, you know, and I need to get into the VIP room. So I'm not going to play the recording now. But she gave a huge amount of value around the stock market. And don't get me wrong, like, should you be investing in the stock market? Yes, you're going to see tomorrow asset allocation. You should have at least a percentage of your portfolio in the stock market. But then the question is, how do you do it? And how do you do it in a cost-effective way? How do you do it to minimize fees and do it safely and securely? And so Anne literally teaches you how to do it. And from my experience, there's no one better in the world that I've found that can teach you how to do it. So this is a gift. And our whole idea today was that you walk away with, you know, Gary Sachs and, you know, London. There's very few people that haven't ever aspired to own a property in London, but doing it at an institutional level. And then Ann Wilson teaching you how to do the stock market in terms of that process. So, okay, so you've got that in the resources as a gift for you. I remind you that, you know, in terms of this unconscious incompetence, conscious competence, you know, this whole journey, you know, you're probably starting to sit here. And don't worry, we've got you covered. You know, what we've been through today is just the tip of the iceberg. I mean, we've had 2 hours, and Wealth Going Global is 6 different modules that can literally help you go a lot deeper in terms of this process. So I just want to share quickly with you what you'll discover about this. It's how to build a globally diversified passive income simply and safely without making the mistakes that most people make when trying to do it by themselves. You know, literally, this page that Shane has got for us, it provides you with the clarity to fill this page in. And if you take the different steps, you know, the first one is the power of clarity, understanding your why. And I go into Simon Sinek and the whole power of getting very, very clear on your why. And the action steps are get clear on your top 5 reasons why you want to make this a reality. And I mean, the feedback we got from people was amazing, profound, amazing session, loved the session, beautiful story. Why, you know, thank you, rewarding, etc. Then you go to countries, and I've already shared with you today the countries, and, you know, understanding the countries. And the mission is to help people choose their top 5 countries and avoid 80% of the mistakes. And, you know, it's understand the GIDS model that I briefly showed you today. It's review and adjust your country data to suit your opinion, and it's choose your own 5 countries. It's to get very clear on the top 5 countries that you want to invest in. And again, downright mind-blowing, great stuff, phenomenal, amazing. Thank you very much. Wow, fantastic, etc. Then you go to currencies and James Painter and the currency conundrum. And the mission here is to help investors diversify their portfolio and mitigate risks by investing in multiple currencies. And ultimately, it's to choose the top 5 currencies. And again, you know, thanks for another great session. Just want both of you to know how much I appreciate you and your passion to impart this material. Thanks so much. Thanks for the knowledge. I enjoyed these sessions, love it, and your passion makes complete sense. Then you go to assets, and this is about selecting the right assets for your investment. Ultimately, it's about the top 15 investments or top 15 assets. And again, I go in more detail about primary and secondary markets, about asset allocation, about the top 15 most recognized assets, the 8 golden rules, and the top 15 assets to be investing in according to the data. I also take you through, if you're in residential, I take you through our 100-layer model. I built this many years ago along with some partners in Australia, and I'll share this model with you. If you're buying any house or apartment anywhere in the world, you should use this to help you make the right decisions. There's 10 layers in terms of where you just, you know, from the country right down to the utilities, the facilities, the condition of the property, and everything in between. Then it's the due diligence on the commercial side and all of the details that one looks into that. So the action steps are review the asset cheat sheets and the deal risk categories, prioritize the asset classes you would like to invest in, and fill in the investment strategy and choose your top 15. And again, people, thanks. You're an amazing teacher. Outstanding session. Great stuff. Love the concept. Brilliant. Okay, wow. It's been a great morning. Really enjoyed today, etc. Then you go to partners, and we're going to go through this on Thursday. But how do you find the right partners? How do you invest globally with confidence? We'll help you find and choose the right partners. And we've got 3 white papers, the 5 laws to building wealth through real estate, the 5 keys to offshore real estate investment success, and the 4 ways to expand your global real estate portfolio through strategic partnerships. I'll teach you on Thursday about the different types of partners and how you actually verify and vet how much experience they've got and how long they've been in the market for. I'm going to share with you our GIDS system, GIDS 1.0, which is all about residential, and GIDS 2.0, that's all about commercial. And the action steps here are read the white papers, design your own due diligence system, or just copy ours. I'm a big believer in copying. And what I mean by that, when I did my dissertation at university, my honors and my masters, I went into the library and I said, hey, who cum laude had their degree last year? And they said, this one. So I took it and I copied it. I copied the structure. I didn't copy the information. I went and did my own dissertation, but I copied the structure. And I too cum laude at my honors and my masters. My philosophy is, why the hell figure all this stuff out from the start? Why not copy what's already working? So breathtaking experience. Your name will appear in my testimonial one day. The devil's in the details. Thanks for another great session. Thanks so much. Very valuable, the DD. Grateful to be present. Invaluable information. Obvious, you put tons of work into this, etc., etc. Then it comes down to the time. And on Friday, we're going to go through building a portfolio and actually having a wealth plan. And this comes down to 85% of your total knowledge and your total return. And so it's ultimately about designing a wealth plan. Now, on Friday, we're going to give you the tools so that you can do this manually if you want. But actually, if you want our system, it'll build you a digital wealth plan, your personalized digital wealth plan. And if you look at the action steps, understand your wealth plan, design your needs and variables, finalize your wealth plan. And, again, thank you guys. You're changing lives. This is amazing, amazing. Another great session. That's excellent. Thank you. Great presentation. Super cool, etc. And then finally, you get the results. You actually walk away. Like, how many of you would like to have a personalized plan, your own personalized wealth plan, plus your investor strategy report? And just to show you, you can bring it all together with technology and make it really, really easy. And so smart investing is how do you use technology to bring it all together? So that's what Wealth Going Global is all about. These are the results that you walk away with. So literally, you have your own personalized wealth plan and your own investor strategy sheet. And if I just share with you, because you might think, oh, well, it sounds a bit too good to be true. If I log in here, I've shown you already the assets. You can go to the partners, you can go to the time. And then ultimately, if you've done your homework each way through, you go to your wealth plan. This is my own Scott Picken personalized wealth plan. And I can literally click on it. And I have my own personalized wealth plan. Like, there's my entire plan. Why am I doing it? How am I doing it? What am I doing, basically? If I want to go to my investor strategy sheet, I can literally go to my investor strategy sheet. And again, I have my own personalized investor strategy sheet, in terms of where I want to invest, what I want to invest in, etc. So both the countries, the currencies, and the assets. Now, I don't know about you guys, but, I think this is super cool. Because what we've done is we've gone and made it easy for people. Like, we've taken all the hard work out of it. We've given you the home study course. Shane's built the systems so that you literally fill them in and you walk away with a plan. Most people don't even have a plan. If you have a plan, then it's about being able to execute on the plan. So if you look at the value of that and what others paid, 11 years ago, the book was $30. If you came on a buyer's trip, it cost you at least $5,000 to fly to America, England, or Australia and come and see it all. When we do the due diligence on some of these projects, we paid upwards of $250,000 before to be part of the due diligence. And, the mastermind, when it started out, was $5,000, just to give you an example. So, it just shows you what people have paid to try and get access to this. What you're going to get the power of clarity. So that module, you're going to get the countries on how to choose the top 5 countries. The currencies, the top 5 currencies, the assets, the top 15 assets, the partners, how to find the right partners, the time, so to build your entire wealth plan, and then smart investing to use technology. You take each one of those modules, it's just short of $7,000. And, we could easily charge $7,000, but our whole philosophy is Zig Ziglar's principle. You can have anything you want in life if you help enough other people get what they want. So if I want globally diversified passive income and I help enough other people get it, then we can all benefit. And yeah, so am I Mother Teresa? No, I'm not. But if I can help more investors invest, then I too am going to get access to better investment. So we're not charging that. A home study course like this with 6 different modules could easily be worth $997, but we're not charging that either. We have sold it for $497. In fact, that was our original launch price, was $497, and we're not even charging that. And the reason being is that we want to kind of make it a no-brainer for people. And so for people that kind of want to pay once off, most people know time value of money. If you want to pay once off, you can literally do it for $297 today. Or, and this is a new thing, we've never done this before. A bunch of people have asked us, well, what about payment plans, etc.? And so we actually have another option, and it's an almighty price of $0. And basically, you'll get 7-day trial to go and try it out. And then after that, it'll be $29 a month for 12 months, which will give you access to the entire program, and you'll be able to go through it, etc. So effectively, we've made it kind of a no-brainer from an affordability perspective. And the reason being is that our objective is to help more people do and get the training to ultimately become investors. Like we're an investment company. We're here to help people invest. And so our philosophy is to help people get results. That's all we're interested in. And so we want to give you the tools to get, results. Now, people say to me, because I get it all the time, well, if that's the case, Scott, why don't you just give it away for free? If you get given something for free, if you look back, if you don't pay, you don't pay attention. Let me rephrase that again. If you don't pay, you don't pay attention. So we do put a value on it, not only because it's worth thousands of dollars. It's taken me 28 years worth of experience to put this all together. But the point being is that if you don't pay, you don't pay attention. And so we've designed this, we've made it really simple and safe and easy for you. And there's a whole bunch of modules that we'll chuck in for free as well as bonuses. So you'll get access to the full Clem Santa presentation with all the different scenarios, the probabilities, and the flags. You'll get access to the Q&A sessions. You'll get access to the community discussion group, to the wealth hackers, to the cheat sheets on property going global, to the cheat sheets on deal risk categories and asset terminology. You'll get access to our calculators. So I've never shared my calculators. I kind of didn't want them out in the public domain, but anyway, we've done it as part of this course. So you've got access to the property going global calculator, the global wealth index, and the freedom calculator. You'll get a VIP entrance to the next event. By the way, if you buy it now and you want to upgrade to VIP straight away, you can do it even for this event. And then just as if you put those values together, it's actually over $8,000 worth of value. And again, just to put in perspective, as a bit of a no-brainer, we do have a 30-day money-back guarantee. I thought from my experience that no one had ever taken that. Shane pointed out last night to me that one person had. So since we launched this in June last year, we've had many people go through it. We've had one person ask for their money back. So at least we know the system works. But yeah, we've got a 30-day money back guarantee just to take risk off the table. And why? Because we believe in it. One of the things that I'm most grateful for is that, the people who've been through this course, we've had teachers, we've had doctors, we've had farmers, we've had highly sophisticated business people, we've had investors, we've had chartered accountants. I'm actually quite surprised how many chartered accountants have liked the course. We've had auditors, someone who audits the Auditor General. So we've had highly sophisticated maths people. We've had teachers, farmers, like I said, people that aren't necessarily sophisticated in finance. And one of the things that I think I'm good at is taking complicated ideas and making them simple for people. So that's really what we've prided ourselves on in terms of this process. So just to remind you, you can either kind of pay once off $297, or you can do the payment plan, which is it's literally free for the first 7 days. And, I kind of think it's a bit of a no-brainer if people are interested. There's the 30-day money-back guarantee. And if you're interested, all you do is you go to wealthgoingglobal.com/join. So I see Shane's put it in the chat box. I know from my experience, there's, the difference between people that succeed and the people that don't. If I take Michael Anisett yesterday and so many other people that watch the webinars, is that they actually take action, they actually do it. And I mean, just, as an example, Micheline and a few of the others that are here that are part of the mastermind, you've already got access to all this, so you don't have to worry about it. We actually built it for our mastermind members because we realized they needed substance and they needed a solid foundation to build upon. I'll talk more about the mastermind over the next coming couple of days. But what's really, really important in Wealth Going Global is that you need to get access to the right information. And this home study course has been built to give you the right information. And it reminds me of a story that Dr. Hannes Dreyer taught years ago. And I'll never forget, he kind of stood on stage. It was a live event, and he had a 100 Rand at the time. And he said, here's 100 Rand. Anyone who comes and gives me 50 Rand, I'll give you the 100 Rand. And there were like 100 or 200 people in the room. And they were like, everyone sat on the bum and they did nothing. And so he repeats himself. He says, I'll give you, let's just put it in dollars to make sure the international audience understands. I'll give you $100 if you give me $50. Everyone kind of sits there and does nothing. And then like one person jumps up and he says, listen, I don't have $50, but I've got $20. Like, if I give you $20, can we do the deal? And Hannes goes, yeah, no problem. Here's the $100. And the guy basically spent $20 to get $100. And he goes and sits back down, and Hannes was like, what's the moral of the story? And I remember this was the first time I saw this. And I was like, wow, that's interesting. Like, why didn't I get up? And it's because we've all been programmed that it sounds too good to be true. And it's quite an important thing, you know, because we've all been indoctrinated with this, it sounds too good to be true. And yeah, Shane's just saying, someone said the link is still showing 497. Shane's just saying, Damien, if you enter your billing details on the next page, you'll see the payment options. Yeah, so yeah, ladies and gentlemen, if you want to go to that page, wealthgoingglobal.com. You can see what other people have said. There's a lot of testimonials there, written and videos from people that have actually done the course. So if you don't trust us, you know, go and look at what other people have said. So let's go to the action steps, because I'm conscious I need to get into the VIP room. The action steps for today, you know, remembering that silver is compulsory, gold is a bonus. So your silver is fill out your top 5 countries. So take your investor strategy sheet, and here's mine with the ones filled out. Fill in your top 5 countries, fill in your top 5 currencies, and fill in your top 15 assets. Okay, I've given you the tools and the information if you want to do it all on your own. That's all there. Then, you know, watch Ann Wilson. So I'd highly recommend watching her as soon as you can. And then share one key takeaway on social media. So it's always the same. And then as a bonus is complete a risk tolerance. So I'm not endorsing this particular risk tolerance, but I went and looked around, and I quite like this one, which just was a risk tolerance. It helps us as investors know ourselves better. Although I'm really excited about what we're doing with the Enneagram, which I've already mentioned. And, you know, watch the space. We will be updating that once that's ready. If you're not sure on the next steps, you know, go to diversificationchallenge.com/next. That'll, you know, give you, it's our navigator to help you go forward. And the prize winner for today is Jerome. So well done, Jerome. Thanks for the engagement. Loved it. And I look forward to seeing you in the VIP room. So I know you've asked some great questions today, which is fantastic. So Shane, thanks so much for helping there. And Jerome, Shane will send you the links to join us in the VIP room. For those of you who want to join the VIP, you know, you can still go to the upgrade and join, basically. I remind you of the homeworks I've posted in the Facebook group, and maybe tomorrow you will be upgraded. But now it's time to go into the Q&A, and just to remind you of all the things that the VIP get. They get to spend time with me now, you know, the best part of over an hour in terms of the process. They get replays to all of these, plus the Q&As. They get lifetime access to the training, and they also get access to the first module of Wealth Going Global. So bit of a no-brainer from a financial perspective, but, you know, for us, we find that people that pay attention. Don't forget to join the WhatsApp group if you already aren't. On the Facebook group, let us know what you thought of today's session. I love feedback from people. I love hearing what they think and everything else. And I remind you that this is why we're here. Globally diversified passive income. It's about diversifying across countries, currencies, assets, partners, and time. I've shared with you the home study course that we've built to make it really easy for people. Shane has shared with you the page, and you can literally go in and you can see here, you got the normal price, you got the challenge promo, and you've even got the, you know, if you want to pay for it up front and or if you want to do it monthly, it's literally there on the page for you. I remind you that the most important thing is about the right information. Today, it's all been about showing you how to get the right information. And I'm going to share with you over time how you get the right partners. So that's that. The plan for day 3 is how to build a diversified portfolio. So tomorrow you're going to meet our family office. You're going to learn about the 6 fundamental pillars to building portfolio construction, and reminding you that portfolio construction accounts for 85% of your total wealth. So it becomes really, really, really important. As Nelson Mandela said, money won't create success. The freedom to make it will. To the VIPs, I will see you in the Zoom room now. To the rest of you, thank you very much for your time. I hope you enjoyed today. I look forward to tomorrow. Remember that each day we're just building on blocks from one block up to the next. And if you need any support in the VIP, please reach out to Shane and he'll be able to assist you. He'll put all the links in the VIP WhatsApp group to make it easy for you. But thank you for your time today. I deeply appreciate it. And as always, it's an honor and a privilege to share all of these skills and knowledge with you. And if there's one thing you take away from today, and hopefully you learned that from Gary Sachs, forget about being a mom and pop investor. It is a high hassle, low return game. It's time to start thinking like an institution, like a sophisticated investor, where you can earn high return, low hassle. And if that is something that you resonate with, then I fundamentally invite you to have that mindset shift. Till tomorrow. Cheers.